This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 6 videos on channels. A channel is simply 2 lines that contain the price action. And to draw a line, you need 2 points. I'll finally talk about the 70% rule, which means that if there's a breakout of a channel, up or down, does not matter if it's a bull or bear channel, there's about a 70% chance that the breakout will fail and reverse and go to the opposite side of the channel within about 5 bars. Every market on every time frame is always contained within channels, whether or not you see them. For example, here we have a very tight bull channel, and here we have a broader bear channel. And within each channel, there are also smaller channels. Here we have a broad bear channel. We have lower highs and lower lows. And within it, we have a bull channel. And within that bull channel, there are smaller bear channels. Let's look at this bull channel for a second. There's a line below and a line above. In a bull trend, the line below is the trend line. In a bear trend, the line above is the trend line. In a bull channel, a bull trend, the line above is the trend channel line. Bull channel, we have 2 points, so we can draw a line. This is the bull trend line. 2 points, we can draw a line at the top of the bull channel, and that is the channel line. Now, we have a broad bear channel, and I can draw a line across these 2 points, and that would be the trend line. And I could draw a line along the bottom, connecting maybe this low and that low, or this low. We have 3 points down here, and the line along the bottom is the trend channel line. So the trend line is on top. It's a bear trend, so the line is on top, the trend line. And the channel line is on the opposite side of the channel. And in a bear trend, it's on the bottom. Here is a 5-minute chart, and we have a bull channel. I have a reversal up, so that's a point that I can use to draw a line. And then maybe we're trying to reverse up here, so that would be a second point. We have a reversal sideways to down. I can use that to draw a line. We have a little reversal down here. I can use that to draw a line. We have another reversal here, another reversal here. This one, if I were to draw a bull trend line here, this would be a break below that bull trend line. So this is possibly the start of a swing sideways to down. And therefore, this is probably a more important point than these points. I'll draw the line connecting this high to that final point, even though when I do that, these bars are above the line. Who knows what is going on other time frames? This is the chart that I'm trading. And on some other time frame, a higher time frame, a 60-minute chart, a daily chart, a weekly chart, there's probably an opposite trend. So a bull trend on the 5-minute chart could be a bear flag on a 60-minute chart or a daily chart. Well, look at this. Here's the daily chart, and this little red box is today. You can see it's a bull trend, opening in the middle, closing on the high, and that is today. This is not the entire day. This is part of the day. The point I'm making is it's a reasonably strong bull trend, but it's really simply a little pullback in a very strong bear trend on the daily chart. Just knowing that it's a bull trend here does not tell you anything about other time frames, and other time frames can be in opposite trends. For example, if I were looking at a 1-minute chart, this would be a bear trend. Now, on every time frame, on every chart, every market, channels dominate the market. Every market is always on every chart, either in a trend or in a trading range. Here we have a breakout, and breakouts are brief. On any chart, a strong breakout typically will be 5 to 10% of the bars on the chart. The other 90% of the bars will either be in a channel or a trading range. Market cycle, you get a breakout, a channel, and a trading range. Here we have a strong breakout, and then many more bars are in a channel. I can draw a line. I have 2 points, 2 reversals, up and then up. And then look what the market did here. It went sideways. But I have 2 reversals down. I can draw a line across the top. I have 2 reversals up. I can draw a line across the bottom. And remember, my definition of a channel is any collection of bars that can be contained between 2 lines. A trading range is a channel. It's a sideways channel, a horizontal channel, but it's a channel. I always draw my lines in a way that best highlights what the market is trying to do. Sometimes that results in bars being above or below the lines, extending beyond the channel. Other times it results in reversals that do not quite reach the lines. Here we have a reversal up, another reversal up, another reversal up. Initially, I'll draw a trend line in a bull trend connecting these 2 lows, but then I see a reversal up here, and I'll change the line and I'll use this low and that low. When I do that, this bar is below the line. Therefore, this is an overshoot. When I draw a line below here, maybe connecting that low and this low, and then create a parallel, and I want to contain what is actually taking place, to me it looks like this high and this high best illustrate what the market is doing. And if I use those 2 highs, then this high in between is above the line, and it's an overshoot of the channel. A lot of times you don't appreciate overshoots and undershoots until after a pattern is complete. So for example, you would not see this as an overshoot of the bottom of the channel until after the market reversed up here. That's okay. And the same is true here. Initially you draw a line using this high and that high, and then you might decide that this is a better high to use because it creates a parallel channel. And once you do that, then this high becomes an overshoot. It went above the top of the channel. Here, once you have this channel drawn this way, you see the market came down near the line and reversed up. It's an undershoot. Had I drawn the line using this low and that low, then this clearly would be an undershoot. It's still a test of the bottom of the channel, but it did not reach the bottom of the channel. Just like sometimes the test will go beyond the bottom of the channel. Traders are always looking at channels, and one of the reasons is they're looking for transitions. We have a bull trend, very strong breakout, and then a channel. But everyone knows that a channel eventually evolves into a trading range 75% of the time. And if it starts to evolve into a trading range, traders need to know that because they'll trade differently once the market is in a different part of the market cycle. When the market's in a channel, especially a tight channel, traders will only look to buy. But once it breaks below the channel, it might be becoming a trading range, in which case traders will also be willing to sell. Bull breakout evolved into a channel, channel evolved into a trading range. And once it's in a trading range, it's still a trading range in a bull trend, so it's a bull flag on some higher time frame. Traders definitely have to favor buys. However, because it's a trading range, they'll also be willing to sell. Here we have a bull trend. We're in a channel. A channel is a type of bull trend. And everyone knows that 75% of the time, a channel will evolve into a trading range. A bull channel is a bear flag, 75% chance you'll get a break to the downside, and then a trading range or a bear trend. 75%. That means 25% of the time you get a bull breakout, and the market cycle starts over. Breakout, channel, and trading range. And that's what we had here. We had a strong bull breakout above a bull channel, so the market cycle starts over. Breakout, and then channel, and then probably a trading range later on. So we had a bull trend that became an even stronger bull trend. We have a bull breakout above a bull channel and the creation of an even stronger bull trend. Breakout, channel, eventually probably a bear breakout below the bull channel, and then the formation of a trading range. I can draw a line using a reversal up here, a reversal up there. Here's the bottom of the channel. I can draw a line using this high and that high, or this high and that high, or simply a parallel of this line. In any case, we have a big bull bar closing on its high and above the top of the channel. Now, remember, 75% of the time, a bull breakout of a bull channel will reverse and test the bottom of the channel, which is what it did here. Will this breakout lead to a stronger bull trend, or is it a buy climax and a failed breakout that will lead to a reversal down to the bottom of the channel, and then either a bear trend or a trading range? In this case, we had a bull breakout above a bull channel, and then a bull channel. Traders think of it as a bear flag because 75% of the time you get a break below the bottom of the channel, below the bull trend line, and either a conversion into a trading range or a reversal into a bear trend. In this particular case, we got a reversal into a bear trend. We have a give up bar here, a big bear trend bar closing on its low, and it became the spike of a spike and channel bear trend. So spike and then pull back and then channel going down. Here we have a bull trend and a bear trend. And a channel that rises is a bull channel. And this is a breakout initially, and then it became a very tight bear channel. Bull channel, trend line below, trend channel line above. In this particular case, I used a parallel. I created this line using this low and that low, and then I made a parallel and dragged it over here to some high that best contains most of the price action. A channel going up, bull channel, a channel going down, bear channel. Even though it's very tight, it's still a channel. On a higher time frame chart, it's probably a breakout, but on this particular chart, it's a channel. Traders are always paying attention to reversals because reversals allow them to draw lines. And as soon as a trader sees a second reversal, he can start to draw lines, this low and that low. Higher low, so it's a bull channel at this point. Initially, when you only have 1 point above, I start with a trend channel line. So I take this line, I create a parallel, and I drag it up to that high to get some idea of what the bull trend might look like. And then I'll pay attention to what the market does if it gets up near that line. If it turns down from lower, then I'll start drawing a trend line above this high and whatever low we have here. We know there's a channel here, even though we don't have a good point for the second line. The channel right now looks like it's up. We have a higher low, but in fact, it could be down. It could be this high and that low, and we could start channeling down. But this is what I'm thinking is a reasonable thing to consider. We have a strong bull breakout and then a reversal up after a weak sell-off, maybe a spike and channel to a higher low. So the odds are we're going to test up. And as I see more bars, I redraw lines, more bars, more information. And then look what happened here. A strong breakout, but terrible follow-through once it got to the area of that line. That tells me that the market is aware of this line. A lot of computers are using this line. They created this trend line below. They created a parallel. They dragged it to this high. And this hesitation at that line tells me that a lot of computers think this line is important. Maybe it's a resistance. Maybe we reverse down. Maybe we break above it. We are reversing down here. So I'm going to draw another line using this high and this high. And I'll wait to see what happens. If we go higher, I'll draw another line. And if we keep getting higher lows here, this line then becomes unimportant, and I'll draw another line with this as 0.1 and maybe this as 0.2. Each new bar that gets added to the chart gives me additional information, and then with each piece of additional information, I reevaluate what I'm doing, and that means that a lot of times I'm erasing old lines and creating new lines. All of us learned when we took mathematics that lines need 2 points. You need 2 points to draw a line. Here we have a lot of points. Every reversal is a possible point. Reversal up, and then a lot of reversal up, and then reversals down, and every one is a possible point that I can use to draw a line. I trade based upon what happens at those lines. Is the market paying attention to the line? When the market gets there, does it break through it or does it reverse? Reversal down, I draw a line. Here the market tested the line, it broke through it. Here I have a very tight channel, and again the market broke through it. Again, a tight bull channel this time, and the market broke sideways and then down. A tight channel, a fairly tight channel here, and the market tested it and broke to the downside. So these are all breakouts. Other times, the market hits the line, it reverses. It breaks through the line, it reverses. It breaks through the bottom of the line, it reverses. Breaks above the top of the line, it reverses. It breaks below the bottom of the line, it reverses. So you can either get a breakout beyond the line or a reversal. In both cases, there's a possible trade. Traders are mostly looking for reversals when they draw lines. We reverse down here and we reverse down here. So I could draw a line using these two highs, but then we broke above it, broke above the line, and we reversed down again. So I could draw a new line using this as 0.1 and this is 0.2. Since the line is sloping down, it's a bear trend line. Therefore, it's a reasonable possibility for a top of a bear channel. Bulls see the bear channel and they hope that the bear channel is a bull flag, looking for two legs down, one pullback, two, and bulls are hoping this bear breakout fails and it's followed by trend resumption up. So bull trend, pullback, and then resumption of the trend. Bears are hoping bull trend, double top, and the start of a bear trend. A bear channel, I always think of it as a bull flag. The odds are it's going to get a bull breakout at some point. And we have a reversal up and another reversal up. Possibly a high 2 buy setup, high 1, and then second leg down, possibly high 2. Right now, this little bull doji does not look like it's enough to reverse these two big bear bars, but it might be. It's around a 50% pullback of this bull trend, and a lot of times the bulls come back at around 50%. We have a bear breakout below a trading range, yet the follow-through bar has a bull body. That's bad follow-through, and it increases the chances that if we go down any further, this more likely is a bear leg in a trading range and less likely the start of a bear trend. If the bear breakout was followed by a second or third consecutive bear bar, it would increase the chances that this sell-off is the start of a bear trend. But this bad follow-through makes it more likely that this bear trend is really simply going to be a leg in a trading range or a bull flag. Remember, we're still above the bottom of the initial very strong rally, and we're about 50% down, maybe a little bit more. So the odds still favor the bulls. It's more likely that this will be a bull flag. Remember, every bear channel is a bull flag. At least in my mind, I think of every bear channel as probably having a bull breakout. So every bear channel, I think, is a bull flag. And every bull channel I think of as a bear flag, because 75% of the time there will be a break below the bull trend line. Now, if there is a channel here, a bear channel, bulls are looking to buy a reversal up. You need 2 points to draw a line. We have 1 and maybe 2. So far, we only have 1 for sure, but if we start to go up here, then this becomes 2. Before it turns up, we still have a second line. We have an obvious trend line above. Traders can create a parallel and then drag it down here to the low point in between, and that would create a channel. This might already be breaking below the bottom of the channel and reversing up. So we have this bear trend line, create a parallel, drag it to the low point in between, and you have a channel. And this could be an overshoot of the bear channel that is reversing up at around a 50% pullback in a bull trend. The odds still favor the bulls at this point. The bears have not done enough to make traders think that the bears have taken control. Traders want to see what will happen here. Will the bear trend continue down and become a bear trend, or is this the end of the selling and the resumption of the bull trend? The line is important. Traders want to see what happens, and so far it looks like the market is stalling at the line. Possibly a big high 2 bull flag, 2 legs down, 1 pullback 2. So if we get a reversal up here, that would be a high 2 bull flag. This would simply be an overshoot, a failed breakout below the bottom of the channel. Bulls look to buy a reversal up at the bottom of the channel. Therefore, they will place a buy stop to buy just above the high of this bar, because that would be a reversal up from the bottom of the channel. And they hope that will get some kind of a second leg up, maybe leg 1, pullback, leg 2. Maybe simply a test of the top of this sell climax, maybe a test of this high, maybe a test of that high. In any case, there's enough room up there for at least a scalp, and bulls will buy above the high of this bar. This bar did not go above the high of that bar. We went lower. But now look what happened. We have a second buy signal, a second attempt to reverse up, the second failed breakout below the channel. We broke below the channel, tried to reverse up, broke below the channel again, trying to reverse up again. This is a micro double bottom, down and up, down and now up again. So bulls will buy above the high of this bar. This is a higher probability buy than simply buying above this bar. This micro double bottom means that the bears twice failed to break below the channel, and that increases the probability that the reversal up will be profitable. Bulls will therefore place a buy stop just above the high of this bar, and they'll get long here. It's a good-looking buy signal bar, a micro double bottom in the bottom of a channel, and a pullback in a bull trend. The math is good. The probability is good that bulls will make money buying right there. And they did. No reason to get out here. No reason to get out here. It looks like we're in the process of a swing up. Maybe leg 1, pullback, leg 2. Maybe we'll go up here somewhere. Lines have to make sense. They have to look good. And if they don't, computers will ignore them. Initially, you draw a line with this low, that low. Once the market goes below the line and starts to reverse up, you use this low and that low. Will computers be using this high and that high? They will, maybe initially, until they start to see that using these 2 bars for a trend line below make this expanding, and this is probably too high for the market ever to reach there. If the lines are too divergent, most computers will ignore that higher line, thinking that the market will never get there. Here we have a strong bull breakout, a pullback, probably a spike and channel up. And we did have that here. We got 2 legs sideways rather than down, and then we have another breakout. A line like this that is not close to parallel to an obvious line, probably not going to be useful. The market's probably not going to reach it. It's better just to ignore it. In general, lines that are closer to parallel or very parallel are much more reliable. Obvious reversal up here, obvious line, create a parallel, drag it to the high point in between, and then see what the market does when it gets up to that line. And you can see a lot of computers did exactly that. They used this parallel line and created a parallel channel, and a lot of traders see it as resistance. Bulls are taking profits, and bears might be starting to sell up there. The closer the lines are to parallel, the more computers will use them, and the more likely they will create support and resistance. Resistance at the top of the channel. The market repeatedly is trying to break above it and failing. Again, you need 2 points to draw a line. And here we have possible 2 points, 1 and then 2 or 2. And then maybe this is 2. So maybe it's 1 and 2. And then maybe this is bar 3, the third point. Now, if there are a lot of bars between 1 and 2, and very few bars to bar 3, traders will not view this as 3 points, 1, 2, 3, or 1, 2, 3, 4. They'll view this whole thing as point 2. So 1 and 2. There has to be pretty good symmetry. The distance between point 1 and 2 has to be similar to the distance between point 2 and 3, and if not, traders will ignore the line, or they'll count it differently from how you're counting it. Here we have just a few bars, and we have maybe 5 times more bars between 1 and 2. So computers will not be looking at this as point 1, point 2, point 3. They'll simply look at it as point 1, point 2, and maybe that as point 3. 32 bars between point 1 and 2, only 3 bars between 2 and 3. This is not a 1, 2, 3. This is a 1 and a 2. And they'll look at this collection of bars as simply point 2 and choose any one of them as the point 2 bar. So point 1, point 2 or point 2, and then point 3. There's still not all that good symmetry, too many bars between 1 and 2 or 2 compared to between 2 and 3, but at least it's not as bad as this as 2 and 3. So more computers will pay attention to this, and they'll want to see what the market does at that third point. We have a reversal down and a reversal down. So I can draw a line, 1 and 2, and that line is probably acceptable through here. But once you start doing this and this is too small of a pattern to influence the market after a big breakout like this. So you can say point 1, point 2, point 3. No, computers are totally ignoring that after this takes place. Very little distance between point 1 and 2. And point 3, at this point, this is point 3, and the market's nowhere near it. Do I keep looking out here for point 3? No, there'll be too many bars between 2 and 3 compared to the number of bars between 1 and 2. So that is not an important line. Computers are not going to be looking at what takes place out here at that line. No one's going to use that line to place trades. There'll be many other more important lines. For example, connecting this high and this high, or this high. This becomes a much more important channel. Only 7 bars between 1 and 2. And at this point, there are 40 bars between 2 and 3, and there's not even a point 3 yet. Bad symmetry, too many bars between 2 and 3 compared to between 1 and 2. And there's not even a point 3 at this point. So you may have to go out 100 bars, 200 bars before the market gets to that line. And at that point, computers will not be looking at that line. There'll be many other lines that are more important. 2 points to draw a line, 1, 2, 3? I don't think so. Once you get strong breakouts like this, these reversals become minor, and computers pay attention to major highs, a high that's followed by a strong bear breakout. This is a major high. So this is the point that the computers will use. A reversal down, very strong bear breakout to a new low, a major high, fairly major high. Computers will use that point and this point, and they'll say, okay, we broke to the upside, but the bear trend resumed within 5 bars, which happens 75% of the time. They draw this line to see what happens in the general area of the line, and then they look to sell a reversal down, expecting a resumption of the bear trend. That line gives traders a location where they can start to look to sell. Strong bear reversal here. At some point, traders redraw the line, maybe somewhere in here. They start wondering if this is the start of a new leg down. So they'll start to ignore this line and then start to use this line, and they'll watch to see what the market does when it gets near it. Traders like to use major highs and major lows for lines. This is a fairly major high. It's a higher low here, but it's still a strong bull breakout and a pullback lasting a lot of bars. The same with here. And you can see lots of major highs and lots of major lows. Reversal up in a bull trend. Point 1, point 2, strong reversal up. Found support here, but broke below the line here. Traders will ignore that line and then draw a new line. Initially, traders might draw a parallel of the first line and then see how the market responds. So they get a bull trend line, create a parallel, and see what the market does. They have a bear trend line, create a parallel, see what the market does. A bull trend line, create a parallel, and see what the market does. A bull channel line, create a parallel, and see what the market does. A bull channel line, create a parallel, and see what the market does. As soon as you have 2 points, you can draw a line, and you immediately know that the market's in a channel, whether or not you're aware of what the top of the channel is. You know that you can draw a line, here a bull trend line, and therefore it's a bull channel. There's some line on top that traders will see as resistance. And when the market comes down to the line, traders will look to buy a reversal up here or a second entry here. They'll also look to take profits on a reversal down at the top of the channel. If the channel is broad enough, some traders will even short on the reversal down from the top of the channel, or at a prior high. For example, at this high, bears sold and made money. Even at this high, they sold, maybe sold more up here. This pullback fell below that breakout point, so the market's in a stairs pattern, and bears will sell new highs and scale in higher, betting that they'll make money. They make a profit on their second entry, and they get out break even on their first. You have a reversal down, you can draw a line. The initial line was probably here, maybe traders looking for a wedge, 1, 2, 3, but it broke strongly above it, reversed down again, so now we have the ability to draw another line. And traders like to see what happens at the top of the channel. Will it reverse down? And they also like to see what happens at prior highs. Will it reverse down? Will limit order bears make money? Will bears selling at this high, scaling in higher, make money? Those are limit order bears. Limit order bears here made money. They sold with a limit order at this high, and it went down far enough for a scalp. That increases the chances that the bull channel will soon evolve into a trading range. I talked several times about the 70% rule. I'm going to talk a little bit more about it here. As I said, you can call it a 70% rule, maybe 75% rule, but the general idea is that if you have a bull trend and you get a breakout above the top of the trend, 70% chance that you'll get a reversal down within 5 bars. If you get a breakout below the bottom of the channel, 70% chance you'll get a reversal up within about 5 bars. And you have a 30% chance that the bull breakout will be successful and start a new market cycle, breakout and channel, and then trading range. Because there's a 70% chance that the market will reverse down to the bottom of the channel, traders will look to sell below bars at the top of the channel, looking for at least a scalp down to the bottom of the channel, assuming there's room here for a scalp. If there's not enough room for a minimum scalp, traders should not take that short. Instead, they should only look to buy reversals up at the bottom of the channel. A bull trend, easier to make money looking to buy at the bottom of the channel than to sell at the top of the channel. A good way to buy, place a stop just above the high of a bull bar at the bottom of the channel, looking for a resumption of the trend up, a continuation of the channel. I think this is pretty interesting. Look at this chart. It's the same as this chart, but the time frame is different. This is a 1-minute chart, and this is a bull breakout above the top of a bull channel. Now, what about my 70% rule? 70% chance the breakout fails within about 5 bars and goes down to the bottom of the channel. Well, there's an additional point about that 70% rule. The 70% rule works on the highest time frame where you can draw the channel. And is this 1-minute chart the highest time frame where I can see this channel? No. In fact, this channel rallied for 200 bars before it reversed down. And my rule is 70% chance it reverses down within 5 bars, but on the highest time frame chart that shows the channel. Here's a 30-minute chart of this 1-minute chart. And here's the same bull breakout that we have right here. This went up for 200 bars, and this went up for 5 or 6 bars. And 70% chance you reverse down within 5 bars. Well, here's 6 bars. And it started to reverse down here. And reversal down, in general, if you get a reversal, traders expect 10 bars, 2 legs. Here we have 1 leg. It's about 10 bars, but it's only 1 leg. So probably traders will sell the first rally, and there'll be a second leg sideways to down. I can draw the channel this way. And there's still many bars here, maybe 100 or more bars above the top of the channel before the reversal took place. But if I draw it this way, using these 2 points, create a parallel, anchor it here, the market's reversing down within 2 bars. Minimum goal, a test to the bottom of the channel. Some computers will use the green line. Other computers will change their minds and then use this orange line for the channel. And they'll look to sell a reversal down if the reversal comes within about 5 bars. This is consistent with my 70% rule. I look at the highest time frame chart where I can draw the channel, and I expect the reversal down to come within 5 bars of the bull breakout above the channel on that time frame. This is not the highest time frame that shows the channel. Obviously, this is a 1-minute chart. I can draw the same channels on a 30-minute chart. This is the highest time frame. So I'm looking for a reversal within 5 bars here, not within 5 bars here. I talked earlier how traders like to see parallel lines, but lots of channels do not have parallel lines. Here we have a small double top, maybe triple top, and a small double bottom, parallel lines. It's a channel. It's a trading range, but it's a channel, and we got a bull breakout. The lines can also converge instead of being parallel. They can get closer together. For example, we have a lower high, and we have a higher low. This is a channel with convergent lines. It's a triangle. As soon as you have 3 pushes up or 3 pushes down, and the lines are convergent, you have a triangle. So 1 high, 2 high, 3 highs. That's all I need to conclude that it's a triangle. And here we have a bull breakout. A triangle is a type of channel where the lines get closer together. They converge. Lines can also diverge. So we have a higher high, a lower low, and we tried to get another lower low. We reversed up several times. This is also a channel. It's a horizontal channel where the lines are divergent. It's a type of expanding triangle. Anytime you can draw two lines on the chart and they contain the price action, you have a channel, whether the lines are parallel, get closer together, convergent, get further apart, divergent. Traders will still watch to see how the market reacts near the lines. In this video, I talked about channels having two lines, and I said that to draw one line, you need 2 points. And then I moved on and talked about the 70% rule, that if you get a breakout above or below a channel, 70% of the time, the breakout will reverse and go to the opposite side of the channel within about 5 bars. However, that rule only applies to the highest time frame that shows the channel. So if a channel is present on the 1-minute chart and the breakout goes 20, 30, or 100 bars beyond the line before reversing, look at a different chart, a 5-minute chart, a 15-minute chart, 60-minute chart, to see if the same channel is there. If so, look at the highest time frame chart that has that channel, and then look for a reversal within about 5 bars. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 6 videos on channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 6 videos on channels. I'm going to begin by using the Forex market to show examples on how to draw bear channel lines, and then I'll move on to the E-mini market and I'll talk about examples on how to draw bull channel lines. With any chart, I'm always looking for reversals. Here we reversed up again. So we have 2 points and I can draw a line. Here we went up and then down, so we reversed down again. I can draw a line across the top. The market might be in a broad bear channel, it might be in a bull trend. As soon as there are 2 reversals, I like to draw lines. So for example, let's take a look at the bear possibility here. We reverse down, so I'll start by drawing a line connecting this high and that high for a possible bear trend. I could also draw the bull trend line, and I might later on, you'll see. Right now I'm using this to draw a possible bear channel. Again, 2 reversals, I can draw a line, and I begin to look for a possible bear trend. In this case, big swings up and down, possible broad bear channel. As soon as I have one line, I like to create a parallel and then drag it to the lowest point in between to get an idea of what a channel might look like. In general, I'm looking initially for channels that are fairly parallel. So creating a parallel of this line and then dragging it down to the lowest point in between gives me an idea of where possible support might be. If this is a bear trend, we go up and down, it will tend to find support at the bottom of the channel. And if it's a bear trend, most bear trends, at least at some point, are contained in a fairly parallel channel. Reversal down, 2 points. I draw a line, I create a parallel, drag it to the lowest point in between. And now we have a possible broad bear channel. What will the market do if it gets down to this blue line? Will it break strongly through it? Will it bounce up and test the upper line? We got near it and we reversed up. In fact, we did not even fall below this low. We have a higher low, so now we have a double top. Most double tops are not perfect. The second high is usually below or above the first high. We also have a double bottom, a slightly higher low double bottom, but still a double bottom. Are we in a bear trend? Well, yes, we're getting lower highs. Are we in a bull trend? Sure, we're getting higher lows. That also means that we're in a trading range. We reversed up again. Whenever I see two reversals, I'm going to draw a line. Every bar that gets added to the chart gives me new information, and with every piece of additional information, I update what I think will happen with the bars to the right that I do not yet see. I have two reversals up. I can draw a line. Now, are we reversing down here? We might be. So at this point, I'm thinking about a possible line connecting this reversal down and that reversal down. We have three reversals down, 1, 2, 3. Whenever the market's in a trading range like this, and there are three reversals either down or up, it's also in a triangle, breakout mode. At this point, it's in a bear trend. We have lower highs. It's also in a bull trend. We have higher lows. And whenever it's both in a bull trend and a bear trend, it's in a trading range. If the market trades down here and you look to the left and say, well, where did that bear trend begin? You would say that it began right here. So we are in the early stages of a bear trend. On the other hand, if the market ends up here, you'll say, oh, well, the bull trend began over here. So this is also in a bull trend. Very common for the market to be both in a bull trend and in a bear trend at the same time. And sometimes the probability of each is about the same as it is here in a triangle. I said every time I get a reversal, I think about drawing a new line. I have a reversal up here. I can draw a line using this low and that low, or this low and that low. And I pay attention to both. At this point, you don't know which line will be more important. And now we have four lines below. We have this one, we have these two new ones, and then that one. All of them might be important. Right now, clearly, these two are important, but I leave all on until it's clear that one or more is no longer important, until it's clear the market is ignoring the line. The bear trend line, right now we have two, here, and either one could be the more important one. The market could go above this high and reverse down at that line, and that tells me that the market is paying attention to that line, and I would then erase this line. You can look at this and say, wow, Al, that's way too much work. Trading is a lot of work, and if you want to make money, you have to do the work. We have a double bottom and a bear breakout. We have three pushes down, 1, 2, and 3. Whenever the market has three pushes down and reverses up, it's a type of wedge bottom. It does not matter that the second low is above the first low or above the third low. That's irrelevant. The market tried hard 3 times to get a downside breakout, and now it's reversing up. It does not matter even if it's not a wedge shape. It's still the same forces that create a wedge bottom. So I think of a failed breakout below a double bottom as a type of a wedge bottom. You trade them exactly the same. Should I buy above bar 3 right here? Well, we have 3 bear bars and 2 are fairly strong, decent size, closing on their lows. In general, you want to wait for a second entry buy. This is a micro double bottom also. We went down and up, and then down and then up. Well, theoretically, you could buy above here. It is a reasonable buy. You're at the bottom of a trading range and you have a second entry buy signal when you get above this bar. We continue down for a second leg, reasonably strong bear leg. and this became a bear flag. We went up, we went down, we went up, we went down again. And this bear breakout fell far below that pink line. The market's ignoring that pink line. It tried to pay attention to it here, but it's clear that it's ignoring it. Now, if anything, it's resistance. We turned down from it. Whenever the market looks like it's ignoring a line, I'm going to ignore it as well. I don't want too many lines on the chart because then it becomes too confusing, too difficult to follow what the market is trying to do. A reversal down, a surprise reversal down, small double top, 1, 2, double top bear flag, or low 2 bear flag on a smaller time frame. A pullback from the breakout below these two lows. Big bear bar, probably a second leg down. This could be the extent of the second leg down. In any case, we rallied and we reversed down. I can draw another line. Two ways to draw a wedge bottom, 1, 2, 3, or 1, 2, or 2, and 3. Let's say 1, 2, and 3. There are two ways to draw a wedge bottom here. Whenever there are two ways to draw the same pattern, some computers will use one, other computers will use the other. We have a bear breakout. Anytime you have a big trend bar, it's a breakout. So we have a big bear breakout. But look at the follow through. We have another bear breakout. And look at this, a bull bar. Another bear breakout, a tail on the bottom, followed by a doji bar and a reversal up. This is weak follow through. Whenever you have a bear trend that has decent bear bars but bad follow through, that bear trend probably is going to be a bear leg in what will become a trading range. Trading ranges have legs that go down, they have legs that go up. And because of this bad follow through, traders are expecting that there will be a bull breakout above the bear channel, the wedge bottom. Bulls will begin to buy reversals up. Some bulls who bought above this high or that high are still long. They might be using a wide stop, maybe based upon a measured move down from this double bottom, a breakout below the double bottom, and they'll use a wide stop, and they'll scale in lower, above a bull bar, or maybe even above this small doji reversal bar. So some of these bulls are using wide stops, holding long, and looking to scale in lower, betting that the bad follow through after the bear bars means this is a bear leg in what will become a trading range, or possibly even a bull trend. So they'll buy more above each new reversal attempt up. Let's say this is the first entry that a trader takes. Let's say he did not take this or this and he buys here. Arguing it's a wedge bottom, two different ways to draw it, 1, 2, 3, or 1, 2, and 3. And it's also at the bottom of a parallel created by this original line. Line right here. We're reversing up from it. Markets tend to reverse if you can draw parallel lines like that. This trader at this point is feeling good. Not great follow through. So just like the bears had bad follow through on the way down, the bulls are getting bad follow through on the way up. It looks like a bull leg in a trading range, but it's still a reasonable buy. And if you have a wedge bottom, traders look for two legs sideways to up as a minimum target. 1, pullback 2, maybe very tight bull channel, more likely 1, pullback, and then 2. We had this line that we drew in earlier, and it looks like we might be reversing down from that line. And it is a low 2 and a broad bear channel. It is a reasonable short, but because this channel up is so tight, and now we have, 8 bars without a bear bar at this point, that reduces the probability that a reversal down will be successful. It increases the probability that a reversal down will be minor, leading either to a trading range or a bull flag and then another leg up. What do you do? Well, you're in a bear channel, trying to become a bull trend, but it's not entirely clear, and we're still forming lower highs. I typically would exit part or all below that bear bar, just in case the bear channel is still in effect. And what about the bears? They see that it's a tight bull channel and that we might get a higher low, maybe a head and shoulders bottom, left shoulder, head, and right shoulder. However, if they're willing to bet on a continued swing down, maybe there's a 40% chance that this will continue down at this point in a bear channel, forming a new low. Bears know the math is okay. Sell below this bar, maybe put a stop just above this bar, and take a chance that we get a new low. If there's a 40% chance of that, there probably is. Their reward is much greater than 2 times their risk, and they have a 40% chance of a profitable swing trade. That math is acceptable, so it makes shorting below that bear inside bar a reasonable trade. Too many lines, so worthwhile removing some lines. Now, we have 2 possible tops. We no longer have a bottom. Yet, we have a major higher low here, a higher low that led to a strong reversal up, and we have another major higher low here, a new low that led to a strong reversal up. It does not have to go to a new high. However, it's a strong reversal up, and at this point, the most logical bear channel line below would be this low and that low right here. New reversals, draw new lines. We might get a parallel channel from here. It's worth considering this as a possible bottom of the channel as well as this. I think it's okay to put both of those there just in case. Well, the bears who shorted below that bear bar, this is a good entry bar, a bear bar closing on its low. It was 40% for the bears shorting below this bar. And with this bar looking like this, if they had taken that short, maybe it's 50% chance now that we'll get down to this low. Bears who sell the reversal down from the top of that channel are short. Do I keep this line? Well, we broke above it and we are reversing down. It's probably better to keep using this point and then maybe move the line up to this point, or this point and that point. I would use this point and that point as the new top of the channel until we get more information. And we sold off with good follow through and then a new low. A high 3 pushes up, 1 above this bar, 2 above that bar, and 3 above that bar. And look where we are. We're at the bottom of the channel. It's reasonable for bears to take partial or full profits on the reversal up. You can argue again that it's a possible wedge, 1, 2, and 3. So reasonable to get out above this bar. Aggressive bulls will buy on this reversal up, especially since it's the third reversal up near the bottom of the channel. I want to point something else out. Let's say you're a bull and you bought as the market fell below this low. You bought here, maybe you made a scalp. And you bought here, you made a scalp. We fell below this low, you bought, you made a scalp. Bulls are buying every new low. They buy this low. Some bulls will buy this low, use a wide stop, and scale in lower, knowing that every prior new low led to a profitable trade if you bought the low. Buying below this low, fell below, you made money. Buying below this low, you made money or made money. Buying at this low, you made money or you made money. Buying at this low, you probably will make money. So bulls are buying new lows. That means it's a stair pattern. The pullbacks from the new lows are going high enough up for bulls to make a profit. So they'll continue to buy new lows until they no longer make a profit. When bulls are able to make money consistently like this, repeatedly like this, in a bear trend, that bear trend probably is soon going to evolve into a trading range. Either buy with a limit order at this low, or better, buy above a bull bar on a reversal up, especially since it's the third attempt to reverse up near this low. Bears should get out of their shorts at this point, or at least out of most of their shorts. Aggressive bulls will buy here. Other bulls will wait 2 or 3 bars to see if we start to get a series of bull bars, and then they'll buy. Higher probability, but if they buy up here, their stop is further away, and there's less profit remaining in the trade because they're entering higher up. IOI, we have a bar, an outside bar, and then an inside bar. So this bar is inside this. This bar is inside that. So inside, outside, inside. A type of micro double bottom, a good buy signal bar, a bull bar closing near its high. This is a reasonable buy. Good entry bar for the bulls, very good follow-through bar for the bulls. Big down, big up, big confusion. At a minimum, the market will probably go sideways rather than down. And it might be the start of a bull trend. We have 3 pushes down, 1, 2, 3. Didn't quite reach that line, but certainly 1, 2, 3. So some computers see this as a wedge bottom, in which case this could be the end of the bear trend. Good buying pressure, 3 bull bars closing on their highs. And this bar is a better bull bar than this bar. Bigger body closing on its high. This bar is better than that bar. Bigger bull body closing on its high. So the market is starting to accelerate upward. This might be, in fact, a reversal up from a wedge bottom. At this point, I think the odds slightly favor the bulls. We're always in long. It's more likely that we're going at least a little higher before we go to a new low. Wedge bottom, even though it does not look like a wedge, it's still a wedge bottom. Traders will be looking for 2 legs sideways to up. Leg 1, we don't know, maybe leg 1 ends up here, and then a pullback, and then a second leg. At this point, had you bought above this bull bar, you would put your stop below this low. In fact, a lot of bulls who buy above that bar and get filled right here, they'll immediately put their stop below this low. A third entry buy, they do not want to see the market fall below. This is a type of nested wedge where the third leg is also a wedge. We have a wedge here, 1, 2, 3, and 3 subdivides into a micro wedge, high 1, high 2, high 3, slightly higher probability. Sold off for 4 bars, 3 bear bars, yet reversed up right around this high. You had some scale end bears who sold this high, sold more higher, and they needed a pullback at least 1 pip below this high to get out with a profit on their second entry, and it looks like they did not get it. This bar represents those limit order bears giving up. So you have bears selling in a bear trend and losing money. Does that sound right? A bear selling in a bear trend losing money? Something's wrong with the premise of a bear trend, and it increases the chances that we'll get at least a second leg up to the top of the channel. The bulls, I do not think they get out below any of these bars, so they hold long. And at this point, a strong enough reversal up. We have 4 bull bars, now 5 bull bars and 6 bars. I think bulls will raise their stop from below here to below here. We have a nested low 2. We have a low 1, pullback, low 2, low 2. So either one of these is a low 2. And the second leg up is also a low 2, yet it looks like it's failing. So the bears who are selling below this low, below that low, below this low, it looks like they're trapped, just like the limit order bears who sold at this high and scaled in higher are trapped. Now you look at this and say, the bears are losing money and the bears are no longer able to make money. And therefore, those bears have to buy back their shorts. That increases the chances that this trend will continue higher. We're at the top of a reasonable channel, a good location to take partial profits, either with a limit order here. In fact, that's what created this tail, in part. You had bulls taking partial profits there, or you could take partial profits on the low 2 below this bar, or the low 2 below this bar. Low 1, low 2, low 1, or low 2, or low 2. Reasonable to take partial profits. especially when things are not all that clear. We're always in long, but where are the consecutive big bull trend bars that typically happen if this is the start of a big bull trend? They're not present, so this is probably not yet the start of a strong bull trend. And if it's not the start of a strong bull trend and you're at some kind of a resistance level and your reward is at least twice your initial risk, it's reasonable to take some partial profits. Maybe you take some partial profits here. A micro double top, up and down, and then up and down at a resistance level, the top of a channel, and a lower high. Just like here was a reasonably strong leg up, we reverse down. You have to be open to the possibility that another strong leg up and we reverse down to another new low. At this point, I think it's more likely that we will not reverse down to a new low and that we'll either stay sideways or continue higher. Okay, we have 6 bars up here with no bear body, and 5 of those 6 bars are bull bars. 3 or 4 of them are closing in their upper half. And the context is good. We have a wedge bottom. The odds are we're going to go at least slightly higher. Is this a strong bull trend? No. Look at all the bars with very prominent tails and small bodies. And bad follow through after this bull breakout. We could not get a strong bull breakout here. We have a decent bull breakout here, but a reversal down here. Bull trend, yes, but it looks more like a bull leg in what will become a trading range. So we have a bear leg in a trading range, the start of a bull leg in a trading range. We have another decent, strong bear bar, and you can argue it's a wedge. 3 pushes up, 1, and then 2, and then 3. So another good location to take profits, maybe below this bear bar. Partial profits, maybe full profits. As far as shorting that goes, when a channel is as tight as this is, it's probably a minor reversal, which means it probably will not fall very far. More likely, it'll fall and form another bull flag for higher prices afterwards. 3 pushes up, 1, 2, 3. A weak rally, lots of dojis and pullbacks, a lot of pullbacks on the way up. Probably a bull leg in a trading range. We broke above this high, just like bulls were buying every new low on the way down and making money. Bears will start selling every new high and willing to scale in higher, expecting to make money on at least a drop big enough for a scalp. You'll have other bears selling below this bar, arguing it's a wedge in a trading range. I think it's a pretty tight bull channel, and I usually don't take that short unless we go sideways and form more of a micro double top. Reasonable location, though, to take partial or full profits. If this is evolving into a trading range, we're in the upper half and we have a wedge rally, and the rally is weak, so it's a good location to take full or partial profits. In a tight channel like this, bulls are buying that low. They're buying with a limit order at that low. They're buying with a limit order at this low or that low, betting that all of those bear reversal attempts will fail. They know it's not a strong bull trend, but they know it's a bad sell, and therefore the market will continue sideways or up. I'm now going to draw bull channels, and I will use the E-mini market for examples. Look at this chart. We have a 5-minute E-mini chart, lots of reversals. Every time you see 2 reversals up, you can draw a line. I could draw a line here, and once it breaks below it and reverses up, I move the line here. Once it breaks below it and then reverses up, I can draw a line here and then here. And the same with lines above. We have a reversal down and a reversal down. I would have a line there. We would replace it once we had the breakout. And here we have a reversal down and a reversal down, another possible top of a channel. And I have a reversal down here, and then a higher high and a reversal down, another possible top of a channel. So this might be resistance. And then what about this? Reversal down, reversal down. It's possible that this channel may continue all the way up here. Reversal down, a possible top of a channel. And we have a reversal down from there as well. Here, 1, 2, 3, 4, 5. We have 5 bars up, no bear bars. Do you think this is a major reversal, or do you think this is simply a pullback from this bull breakout, a pair of consecutive bull trend bars? It's more likely a pullback from a strong bull breakout. This reversal down probably is not going to go very far. I would rather wait for a second signal. So maybe we go up again and then get a double top. That would be a higher probability short than this. Alternatively, if we start to reverse down strongly, then I'll start selling lower. Right now, at this point, more likely buyers at the low of this bar and lower, and that this will form a bull flag and we'll get at least a little bit more up. And that's what we got, a very strong bull breakout, and the bears are giving up. Not only did we break above this 3-bar bull flag, we broke above this high and above that high. Are computers paying attention to this line right now? No, this line does not help you at this point. You get rid of it. Anytime the market appears to be ignoring a line, get rid of it because it just clutters the chart and it makes it more difficult to see what the market's trying to do. Initially, this line appeared to be unimportant, but we're getting close to it, so the market might see this as a possible top of the channel. Anytime I see any reversal, I'm always drawing lines. And I want to see what the market will do when it gets near those lines. And initially, this line looked much less important than other lines. At this point, those other lines are clearly unimportant, and you have to be wondering, is this the start of a bull channel? Will this be resistance? Will bulls take profits there? Will bears sell there? Possible double top, we reverse down around the same price level. This is a possible double top. We have a neckline down here, but we tried to go down. Instead, we're breaking strongly to the upside. A bull breakout above a double top, 3 pushes up, 1, 2, and 3. If this bull breakout fails, then we'll have 3 pushes up, 1, 2, 3. Whenever you have a double top and a bull breakout that fails, you have 3 pushes up. That is a type of wedge. Also, we tried to reverse down here, and we accelerated upward here. And this is the best looking bull bar in more than 20 bars. It's the best looking bull bar in 60 or 70 bars. Whenever you see that, you have to be thinking that instead of a measuring gap, this might be an exhaustive end of a trend. It could be a second leg trap. So this could be a wedge, bear flag, first leg, and then a second leg, and we reverse down. I'm always thinking about a bear case whenever the market is in a bull trend, because 40% of the time, the bear case will in fact be correct. Different ways to draw lines: reversal down, reversal down, reversal down. I'm always drawing lines, and I want to see what the market does near any of those lines. Will it ignore the line, or will it reverse? Whenever I have a channel with fewer bars and there's a channel with more bars, the channel with the fewer bars usually is less important, but sometimes it's important. The bigger patterns are usually more important. Clearly an important bull trend line, and I'm always thinking, okay, if the market falls below this line, maybe the bull trend has ended, especially if it falls below this major higher low. A strong breakout to a new high. This is clearly a major higher low. Because it's major and I can draw a line, I'm always going to draw a parallel and connect it to the highest point in between to create a parallel to see if in fact this is the bottom of the channel and that parallel is the top of the channel. There's the parallel line. Possibly, this could be the top of the channel. We don't know what was to the left, but let's say this was the top of a rally. Then this is also a possible top of a bull channel. We have a micro double top, up and then pause, and then up again and then pause. This might be the end of this move up. As I said, it could be a second leg trap. First leg is this wedge, and then very strong breakout and second leg. We're failing above the high of the channel, the top of this blue channel line, and we're failing within 5 bars. We continued up 3 bars and are reversing down. It's a plausible top, not a strong short, but a possible top. You can call it a parabolic wedge, 1, 2, 3, where the third push goes above the top of the line, so it's a parabolic channel. We have a couple things now in favor of the bears. Could be a failed breakout above the top of this trading range. 2 ways to draw the parabolic wedge, either with the green line or the purple line. I'm always looking for other resistance. A very common type of resistance is a measured move target. We had a strong leg up here, and then a pullback, and then a strong breakout. We are just about almost at a perfect measured move up based upon the height of this original leg. So that is also resistance that some computers will use either to take profits on their longs or to go short, and that's what caused this slight reversal down. Bulls might take profits exactly at the line or a tick or two below, or on the reversal down, a micro double top, and many different ways to draw wedges, and a failed breakout above the top of a bull channel, and a failed breakout above the top of a trading range. Low probability short at this point, but reasonable short. So some bears will sell below the low of this bar, or maybe even below the low of this bear bar closing near its low, putting a stop up here, knowing that at this point they might have a 30% chance of a profitable trade, but it could be the top of the move and we could come all the way back down to the bottom of this buy climax, possibly all the way down to the bottom of the trading range. That means that even though their probability is small, their reward is so much bigger than the risk, it's reasonable to take that short. I usually do not take that short. I wait until I see more strength on the part of the bears. But some bears will take that short. It has a positive trader's equation, but a low probability. I like to win most of the time, so I usually do not take low probability trades, even though the math is okay to take a trade like that. And look what we got. We have about 8 bars down here, probably a big enough reversal so that we'll get a second leg down after any bounce. I'm typically selling either at the high of this bar or maybe the second or third consecutive bear close, expecting that we'll get at least a lower high and a second leg down. But it is okay to take that short as well. Where are the targets on the downside? Well, the top of this trading range, you can call it a triangle, 3 pushes down, 1, 2, 3, even though this is slightly below that. You can call it a trading range, and we're testing the top of that trading range. That is support. It was resistance. We sold off at this price repeatedly. We broke strongly above it, and now we're pulling back to it. There will always be some buyers here, bears taking profits and bulls buying. Other targets on the downside are the bottom of this buy climax, or the bottom of this bull leg, or even the bottom of the bull leg here. At this point, I think it looks bullish. 2 legs down, 1 pullback, 2, and the pullback looks much weaker than the rally, and we're forming a higher low, and a breakout test, a pullback to the top of this trading range. High 2 bull flag, 2 legs down, 1 pullback, 2. You can call it an ABC pullback, A, B, C, testing the top of the trading range. Tests are rarely perfect. I think of it as a zone, and I'm not surprised if it falls a little bit below those highs. It did not fall strongly below, and we're forming a micro double bottom. We went down, we went up, we went down a little bit, so reasonable to buy, maybe above the high of that bull bar, possibly for a test of this lower high or a test of that high. In any case, these bears will almost certainly take profits above the high of this bull bar because of all the things that I said. A 2-legged pullback testing the support at the top of the trading range, and after a very strong reversal up. This is a lot of work. You're constantly drawing lines, you're constantly taking trades. A lot of the trades don't work, you're getting out. No one's going to pay you just for sitting in front of your computer. If you want to make money, you have to do the work, which means you have to be thinking constantly. And you have to be constantly changing your opinion. I use the Forex market to give examples of how to draw lines in bear channels. And then I use the E-mini market on how to draw lines in bull channels. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 6 videos on channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 6 videos on channels. I'm going to begin by talking about how often new trends begin while an old trend is still in effect. I'll then move on to talk about trends and higher time frames. And finally, I'll talk about reversals and breakouts. I want to make an important point here, and it's, I think, something that traders often overlook. Traders think that a bull trend like this can suddenly become a bear trend. There's actually a transition that takes place, and very often the bear trend starts before the bull trend has ended. For example, we have a pullback, we have another pullback. It's forming a higher low inside a bull channel. However, the last higher low in a bull channel can in fact be the start of the bear trend. So yes, it's still a bull trend, we're still going higher. However, this bear trend, this pullback, actually began probably right here, at least in the minds of a lot of traders and in the algorithms of a lot of computers. It doesn't matter that the bull trend extended beyond the high at this point. This is the transition. We have a bull trend, and at this point, although at this moment you don't know it, the bear trend is actually started. Once the bear trend begins, somewhere in here, you're going to conclude that, maybe this pullback was in fact the start of the bear trend, even though the bull trend was still in effect. Remember, a bull trend usually transitions into a bear trend. It doesn't immediately reverse into a bear trend. And often the final pullback in a bull trend is in fact the first pullback in a bear trend. For the bears, they see this as a wedge bull flag. 3 pushes down. 1, 2, 3. It does not matter that the high of the bull trend came after the start of the bear trend. At this point, we have a bull trend and the beginning of a bear trend. You did not know it here, but after this and after that, you look back to the left and say, where did the bear trend begin? It probably began right here, even though the bull trend was still in effect. This is very common, and probably 50% of wedge bull flags have a high following the beginning of the pullback. 3 legs down, 1, 2, 3, and it's pretty good selling pressure, a lot of bear bars. When you have a wedge bull flag like this with pretty good selling pressure, it often becomes the final bull flag in the bull trend. In other words, you get a bull breakout, but the bull breakout might be the final leg up before the bull trend transitions into a trading range. Again, the bull trend ended here, but the bear trend began here. A bear channel, in this case it's a wedge bull flag, but it's still a bear trend. The opposite is true when you have a bull channel. Here we have a bear trend, and we have a pullback, and then we have a resumption of the bear trend. However, where did the wedge bear flag begin? Did it begin right here? Is it a low too short, 2 legs up, 1 pullback 2, a double top 1, 2? Or in fact, did the bull trend, the small bull trend, the bear flag, begin right here before the bear trend ended? I think at least in my minds, and I think in the minds of a lot of traders and in the algorithms of a lot of computers, this is the start of the pullback, even though the bear trend had not yet ended. Again, a bear trend often transitions into a bull trend before the bear trend ends. Very often, the final pullback in a bear trend is the first leg up in a bull trend. Wedge bear flag, 3 pushes up, 1, 2, 3, even though that first leg up occurred before the bear trend ended. Also, you have a double top, a bull breakout. Whenever you have a double top and a bull breakout that reverses, that is a type of wedge. You have 3 pushes up, 1, 2 for the double top, and then the breakout is the third push. So the reversal is the start of a wedge bear flag. So 3 pushes up, a wedge bear flag, a double top, a failed bull breakout, that is a variation of a wedge. And again, the wedge began before the bear trend ended, probably half of the time that is the case. Three pushes up, so pretty good buying pressure. And whenever you have pretty good buying pressure in a wedge bear flag late in a bear trend, it often becomes the final bear flag before you get a bigger reversal. Here we have a wedge bottom after that wedge bear flag, and this led to a double bottom or slightly lower low major trend reversal. Again, a wedge late in a bear trend often becomes the final bear flag before there is a major reversal. We have a bear channel, lower lows, lower highs. However, the final lower high in a bear channel can be the first high in a bull trend. So the bull trend can start before the bear trend ends. Here we have a lower high, did not go to a new low, and it was the last lower high of the bear trend. It was followed by a higher low in this case, and the start of a bull trend. Bear trend, a lower high, and sometimes that lower high will be followed by a new low and then a reversal up, and sometimes it's followed by a higher low and a move up. The first high in a bull trend often is the final high in a bear trend. We have a bull trend and a higher low. But that higher low in the bull trend was actually the first push down in a bear trend. We have a low, lower low, lower low. This low in the bull trend was followed by a rally, but it failed to get to a new high. Even if it went to a new high and turned down, it still could have been the first low in a bear trend. Look at the sell-off. Bear bar, bull bar. A couple small bear bars, bull bar. The bear trend is lacking consecutive big bear trend bars. Also, it's holding above the bottom of the bull leg, and the entire sell-off looks weaker than the two big bull bars that went up. This might be, in fact, a wedge bull flag. 3 pushes down, 1, 2, 3, and the odds are the bulls will get trend resumption up. A bear leg in a bull flag is more likely than the start of a bear trend. And you can see we've got a bull breakout and trend resumption up. So bull trend, pull back into a bull flag and trend resumption up. Three pushes down, a bear trend, strong bear breakout, 3 pushes, 1, 2, 3. Where did the bull channel begin? I always look to the left to see if there's a first leg up within the bear trend. And I draw lines connecting highs, reversal down. So that's a possible first point of a line, reversal down, second point of the line. And while you can argue that it's 2 legs up from this low and the bull trend began here, some computers instead will say the bull trend began here and it's a wedge rally. 3 pushes up, 1, 2, 3, even though the bear trend had not yet ended. the transition often means that you have a bear trend and the bull trend begins before the bear trend ends. We got a high, but a lower high. The biggest bull bar late in the trend, possibly an exhaustive bar, and a failed breakout above a bull channel. And we ended up with a lower high, a failed breakout, a buy climax, and a reversal down. Big up, big down. We have a double top and a breakout, and it's a failed breakout above the double top. It actually extended up for about a measured move, but still a lower high. When I'm looking at this chart, I understand the argument that the bull trend began here. I would look at this chart and conclude that the bull trend began here before the bear trend had ended. So the first rally was actually still part of the bear trend, and it's a transition from a bear trend to a bull trend. And in a transition, a lot of times there are components of both. At this point, for example, we're still in a bear trend. We still have lower highs. And we don't know until up here. We don't know that this, in fact, is part of the bull trend. And we don't know until we're up here that this might be, in fact, part of the bull trend as well, even though it's still in the bear trend. The important point is that when a bear trend converts into a bull trend, often the beginning of the bull trend starts before the bear trend completely ends. It's part of the evolution of bear to bull. Again, when you're drawing lines, I'm always looking for reversals. We have a reversal down here, reversal down here, reversal down there. Well, I can draw a line using that high or this high, and then this high or that high. We have two reversals down, so possibly the start of a bull trend. You can see the line is going up, yet this low is below that low. It does not matter that the bear trend had not yet finished. The bull trend might have begun before the bear trend has ended. And that's just part of the evolution of a bear trend into a bull trend. The early parts of the bull trend often form while the bear trend is still underway. You can see we got a lower low in the bear trend, but the bull trend probably began back here. Is this line important? Well, we don't know. Is this really the start of the bull trend? Well, it might be, but you need some validation of this line. What will happen if the market gets up to that line again? All right, it reversed down. That tells you that the market considers this line important. Where did the line begin? It began over here, while still in the bear trend. So this illustrates that computers and traders thought that the bull trend began here. This is where the line began, and it began before the bear trend had completed. And the trend line, 1, 2, 3. So we got a wedge top and two legs down, 1, pull back, 2. Incidentally, whenever I see a wedge top, I'm expecting two legs sideways to down, not necessarily down. It does not have to be 1, pull back, 2. It can be 1, pull back, 2, mostly sideways. You never know in advance what the majority of computers will use as their lines. And there are many ways to draw lines. I can use that low and this low. Some computers will use that low, other computers will use this low or that low. If I initially use this blue line, 1, 2, I see the market reversing up here at 3. That tells me that the computers are probably not considering this as the start of the bear trend. We have the top of the bull trend and possibly the start of the bear trend, but the market did not reach that line. However, look at this line, 1A instead of 1. Look at 1A, and I connect it to 2. Look what happened when the market got here. It reversed up here. It reversed up again here. Which point do you think is the start of the bear channel? This one? the market never got there, or this red one, the market got here, reversed up, got here again, and reversed up. This red line looks like it's more likely part of the bear channel, and I look to the left, and I can see this is where it began. Yet, the bull trend was still going up. We still got a new high after the start of the bear channel. That is very common. Probably half of the time when you get a bear trend, it begins before the bull trend has ended. I want to talk a little bit about higher time frames. This is a 60-minute E-mini chart. And we have 3 pushes up, 1, 2, 3. The spacing is not great, a lot of space between 1 and 2, much less space to bar 3, but it's still 3 pushes up with reversals down. So effectively it's a type of a wedge, even though it does not have a wedge shape. Could I also use this high? We got a reversal, this high, reversal, this high, reversal. Sure, some computers will be using that instead. 1 or 1, and then 2 and 3. I always like to connect 1 and 3, and I don't care if 2 is above that line. If I see a reversal down at a potential 0.3, I conclude that that is the correct line, and 2 is an overshoot. If you're a day trader trading on a 5-minute chart or a 15-minute chart, higher time frame signals like on the 60-minute chart or the daily chart come much less often, but they still can be important. And if you look at a 5-minute chart, especially if you use a bar chart which has a lot of bars on the chart, you can see the same lines. On the 60-minute chart, a lot of bear bars, and some of them are pretty big. And here we have 4 consecutive bear bars, 2 consecutive big bear bars. So there's pretty good selling pressure. There are also usually other patterns within patterns. For example, we got a low, a lower low. We have a high, a higher high. It's a type of expanding triangle. The shape is not particularly good. That means that most computers will not be paying much attention to this as an expanding triangle. However, they are paying attention to the market reversing down at this line and that line. Top of the channel, we're getting a failed breakout attempt and a reversal down. Here we have a low 1, low 2. I also like to pay attention to consecutive tops, which is a variation of a low 4 pattern. So did the market try to top and then fail and then try to top again? For example, here at 1, 2, 3, we tried to get a wedge top here, but we broke strongly above it. Strong enough up, so a second leg up is likely, and we got that here. So we got 1, 2, 3, first top, and then 2 more legs up, second top. Consecutive tops. We tried to get a wedge top here, it failed, and then we got another couple legs up, and this double top succeeded. Even though it's a low 5, 1, 2, 3, and then 4, 5, it's still a variation of a low 4. I prefer to use the term consecutive tops because a lot of times low 4s can be consecutive wedges. So it could be a 3 and a 3, it could be a 2 and a 3, it could be like here, a 3 and then a 2. The important point is the market tried to top, it failed. We got a couple more legs up, and the second attempt at a top was successful. Higher probability sell when you get a second consecutive reversal pattern. Bears will sell, expecting at least a couple legs down. 1, pull back, 2. They sell just below the low of that bar. Take a look at this. This is the same chart. The last chart was a 60-minute chart. This is a 5-minute chart, and I compressed the bars so that it would look the same as that 60-minute chart. And these lines are the same. 1, 2, 3, and then over here as well. You can compress the bars and put a whole bunch of bars on the chart and get the same shape as I just showed on that 60-minute chart. This is a close-up of that 5-minute chart at the top. Traders could sell below that bar, or we have now a double top. They can sell below that bear bar or below this bull reversal bar. It's a reversal bar with a bull body. Now, why would anyone do that? They see the lines on the 60-minute chart. Why not just trade it on the 60-minute chart? A lot of traders will look for patterns on higher time frame charts and then look for entries on lower time frame charts because they usually can enter with less risk. The bars are smaller, so the risk is smaller. On the 5-minute chart, you would sell here or here, and that's actually 3 to 4 points better than taking the entry on the 60-minute chart. For example, if you enter on the 60-minute chart, your entry would have been here. If you see the lines on the 60-minute chart, you can turn to a 5-minute chart and look for a reversal on the 5-minute chart and often get in at a better price and with less risk. I'm going to talk a little bit more about reversals and breakouts. My 70% rule: whenever the market is at a channel, the top or bottom of either a bull or a bear trend, there's about a 70% chance that the market will reverse. Point 1, point 2, 70% chance you'll get a reversal at point 3. Point 1, point 2, 70% chance you'll get some kind of reversal at point 3. This is a bull trend, and this is a bear trend. It does not matter that this is the top of a bear trend and this is the top of a bull trend. 70% chance you're going to get some kind of a reversal, a tradable reversal. The same is true with the bottom of a channel. Here's the bottom of a bear channel, 70% chance point 3 will reverse up. Here's the bottom of a bull channel, 70% chance point 3 will reverse up. Point 1, point 2, I draw a line, this is point 3. This is a very strong breakout. We have a weak rally for a first leg up, and then a very strong second leg up. If this is in a bear channel or in a trading range, you have to be thinking that it might be a second leg trap. So leg 1, pullback, and then very strong leg 2, an attempt at a breakout and the conversion into a new market cycle, breakout, channel, trading range. However, if the bars to the left are sideways and the market is now at the top of a trading range, or if this is a bear channel, this could simply be a second leg trap and lead to a reversal down. In any case, when you have a very strong rally like that, I'm not going to sell here. I need at least a second reversal, some kind of a double top. Whenever a setup is not strong, it's not strong to sell immediately after a strong bull breakout. It's better to wait for a second signal. And here we also have a good sell signal bar, just as we have here. This is a higher probability short than that. A great looking bear reversal bar usually is not enough to reverse a very strong bull trend. Usually you need to wait for a second signal. Usually this will be a minor reversal, which means a bull flag, and there'll be at least one more leg up before the bears can get a significant, tradable, profitable short. This is the short below the second attempt, a double top. I'm constantly drawing lines. After every failed breakout, I redraw the lines. We have a reversal down, 2 points, I draw a line. We have a reversal up, 2 points, I draw a line. But then I break strongly below the line. What do? It broke strongly below the line and reversed up. You know what I'm going to do. I'm going to get rid of that line and draw a new line connecting this low and that low. The market's telling me it's ignoring this line. Well, what am I going to do? I'm going to ignore that line. Now we have a potential channel, and this line is close to parallel to this line, so I'm going to leave it there, even though the spacing might not be good between point 1 and point 2, and then point 2 and point 3. Very strong reversal up, but look what happened. We reversed down. So point 1, point 2, point 3, top of the channel. It didn't matter that this is very strongly up. It reversed down. When I see a big bear reversal bar after a breakout like this to a new high, I'm not going to short that after this much buying. However, I will look to short a second reversal down, either here or here below that bear bar. Reversing up, well, you know what I'm going to do. I'm going to draw a new line. I could draw the line from this low to that low. I'm initially going to draw it from this low to that low. As trends mature, as more bars get added to the trend typically becomes weaker and it tends to evolve more into a trading range. By weaker, I mean flatter. I had one line here and now I have a flatter line. So the channel is becoming flatter, less strong. And also the channel tends to get broader. The space between the top line and the bottom line tends to get wider. And that is a sign that the market might be starting to transition into a trading range. And that's ultimately what we had. A double top, double bottom, another push way down here. So this looks like the bull trend has evolved into a trading range. Obviously a bull trend, different ways to draw it. Some computers will use this for point 1, others will use that. It doesn't matter. The lines are very close to the same place when the market ultimately reversed down. What's the target? I said 70% chance if the market tests the top of the channel, it's going to reverse to the bottom of the channel. Well, we have a bull trend. Where is the bottom of the channel? There are often many possibilities. An obvious one is this. We have a reversal up, a second reversal up. So that is a reasonable possible bottom of the channel, especially since it's fairly parallel with those two lines. What about a parallel of that blue line? Well, the market doesn't appear to be paying much attention to that parallel. What about drawing a line connecting these two red lines? That yellow line is a parallel of this yellow line. But what about connecting these two red lines? Again, all of these lines are close together, and the market's not reversing up strongly from either of those lines. Are there any other lines? Well, are there any other reversals? We got this low and that low. That allows for a line as well. However, the market fell strongly through it, so the computer is not listening to that line either. It's important to keep drawing lines and watch how the market reacts when it gets near a possible line, a possible bottom. You look for a strong reversal up, or you look for a breakout to the downside. And if you get the downside breakout, you often get a couple legs down. I think this chart is particularly interesting. This is the S&P Cash Index, a monthly chart, and this is the 1987 crash. I began trading right before that crash. I'm sure very few of you were trading at that time. The news made it sound like it was recurrence of the 1929 crash and the start of a depression. But what happened? We got a micro double bottom and then a bull trend. Look what happened. We have a reversal up, we have a reversal up, reversal up. You can draw a line. Even though this crash was huge at the time, the market fell 25% in one day. Where did it stop? At a trend line. And I think it's really important to recognize that, plus a micro double bottom. A lot of times when the market has a huge collapse and then a micro double bottom, it'll channel up. That's a very common pattern, even though the crash looks like it's the start of a huge spike and channel bear trend. So spike, pullback, and then maybe bear trend. We had that in 1929. We had a spike and channel bear trend. Here we have a spike and a micro double bottom at a bull trend line, and the bull trend continued up. As disastrous as this looked at the time, it's really not a significant event in the big picture. For example, look at what took place since then. Here's that 1987 crash. As disastrous as it looked at the time, it looks like nothing today. We had a big reversal down here, another big reversal down there, but we reversed up, I can draw lines. Look at this, the 2007, 2008, 2009 collapse. It ultimately reversed up, but where did it reverse up from? Connect these lows. And just like the 87 crash bottomed at a bull trend line, the 2009 crash reversed at a trend line. And that is an important reminder to keep drawing lines, because every sell-off, no matter how strong, ultimately is going to reverse up, and it's always going to reverse up at a line. In this video, I talked about how new trends often begin before the prior trend has ended. There's a transition from one trend into another trend, and the beginning of the new trend often starts while the old trend is still in effect. Traders often find patterns on higher time frames and then switch to lower time frames to find earlier entries. And finally, I talked about reversals and breakouts, and in particular, every major reversal, like in the 1987 crash or the 2009 crash, comes at some kind of a trend line. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 6 videos on channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 6 videos on channels. I'm going to begin by talking about different types of channels. I'll move on to discuss tight and broad bull channels, and then finally I'll talk about tight and broad bear channels. A channel is simply an area of the chart that can be contained between two lines, and that includes a trading range. A trading range is simply a horizontal channel. You can draw a line across the top and a line across the bottom. And in this video, I'm going to be talking about channels that are in trends, like a bull trend or a bear trend. In a bull trend, I draw a trend line along the bottom, and then the line across the top is the trend channel line. In this case, I have it drawn as a parallel. As I said, if you have an area on the chart that can be contained between two lines and that area is horizontal, it's a trading range, but it's still a channel. Sometimes patterns are not all that obvious. For example, here there's a small expanding triangle. I have it drawn here using this high. It probably began with this high, so up here, we went down and up on that bar, and then down here, and then up here to there, and then down and up. But it's still a type of channel. It's contained between two lines. In an expanding triangle, the lines are diverging. They're getting further apart. Other times, triangles are converging. Here we went down and up and down and up and down. I know that if you use this high and that high to draw the top, the second point is above. But anytime I have a trading range and the lines are pretty much convergent, I think of it as a triangle. It doesn't matter if you call it a triangle or simply a trading range. You can call it a diamond pattern, which is an old-fashioned type of reversal pattern. It doesn't matter. You know that the market is sideways. After a bull trend, it's in breakout mode, and it may resume up, it may reverse down. And when the chart starts to get into a convergent channel, that means the market is probably fairly close to breaking out. Again, there are triangles on this chart as well. Whenever I see a trading range and I can draw lines that are convergent, I think of it as a triangle. There's a triangle up here as well. 3 pushes up, 1 down, 2 down, 3. That's a triangle as well. And if you have a diagonal channel, a trend channel, but it's convergent, I think of it as a wedge. So we've got 3 pushes down, 1, 2, 3. And that allows me to draw a line, and then I can draw a bear trend line on top, a wedge bottom. Patterns are rarely perfect, and you have to be flexible. When I started out 30 years ago, I would look at books and magazines, and the patterns were all perfect. If you look for perfect patterns when you trade, you're never going to trade, because perfect patterns are rare. They are the exception. Most patterns are not perfect, but the computers see them, so you have to be able to see them as well. A trading range, you have to be thinking about a breakout, and I'm always looking at lines, and you can see you can draw convergent lines. So this is a triangle after a rally, and it turned out to be a part of a double top, and it led to a bear breakout. I'm always looking at reversals, and they allow me to draw lines. We have a reversal up, another reversal up, I can draw a line, and then see what the market does when it gets down to the line. It reversed up again. And you can see I can draw a line across this reversal down and this reversal down, a wedge bottom, and we got a strong breakout to the upside. A bull breakout or a spike, and then a pullback and a channel. So it's a spike and channel bull trend. Fairly tight channel, but it's still a bull trend channel. Another trading range, 3 pushes down, 1, 2, 3. Possibly a triangle, 3 pushes up, 1, 2, 3. I know you're saying, well, Al, that's not a good push up. It didn't even go above the high of that bar. On a smaller time frame chart, that is a small rally, and then a sell-off, a rally, sell-off, rally, sell-off. So this is an expanding triangle. Again, it doesn't matter if you call it an expanding triangle. It doesn't matter if you call it a head and shoulders top, left shoulder, head, right shoulder. The market's in breakout mode. Head and shoulders top. Instead of breaking to the downside, we broke to the upside. Not perfect, but a trading range. It looks like this is a reasonable top to the range. We turned down, we turned down, we turned down, we turned down, we turned down. We tried to break to the upside, it turned down. And this is a possible bottom to the range. Every head and shoulders top is a trading range. And here the neckline is the bottom of the range. Horizontal channel, it's a trading range. I'm going to talk now about bull channels, both tight and broad. Every trend is in a channel at some point, and every chart has channels on it. We have a breakout here, it continued here. On a higher time frame chart, this is simply 1 or 2 or 3 big bull trend bars. It's a breakout, no pullbacks, it's a micro channel. And then here we have a bull channel, but the pullbacks are small. They're only lasting 2 bars here, 1 bar here, 3 bars here, and they're not dropping very far. This is a very tight bull channel, and on a higher time frame chart, that tight bull channel is a breakout. And because it's a breakout on a higher time frame chart, it's better only to look to buy. Tight bull channel, it's a breakout on a higher time frame chart, better only to look to buy for any reason. Below bars, reversals up, doesn't matter. And bears should not sell. Even if they sell with limit orders at the highs of bars, the market rarely pulls back far enough for them to make even a scalp. Here, if you sell this high, you lose money. Tight bull channel, better only to look to buy. Again, a tight channel, it's a breakout on a higher time frame, so only trade in the direction of the trend. There are pullbacks. This bar fell below that low. These bars fell below that low. So it's a channel instead of a breakout on this time frame. But the bears are only in control briefly here for 1 bar. Here they couldn't even get a pullback. They just got a pause. When you look at this chart, you'll say, well, the market's going up. Yes, it's going up. But how is it going up? Is it a breakout? Well, there's a breakout here, but this is not a breakout. This is a trading range. There's a breakout here, but there's a reversal here, and there's a big gap down here. Yet, it starts in the lower left, ends in the upper right. It's a bull trend. It's a broad bull channel. And with broad bull channels, they often have times when the market is always in short. Maybe it's always in short here, maybe it's always in short here. The market fell below a major higher low. This higher low broke strongly to a new high, yet we fell below it. However, we're still above this low, the bottom of the bull trend. Broad bull channels often have times when the market is actually always in short, but still within the broad bull channel. And when a channel is broad like this, it's always good to trade in the direction of the trend. So it's always good to be buying. But when the reversals are as deep as they are here, as they are in broad bull channels, bears will sell, knowing that the market will fall far enough for a profit. A broad bull channel is similar to a trading range that's simply sloped upward. Bulls can buy for swings and for scalps. Bears, it's usually better only to sell for scalps until you're confident that the market is in a bear trend. As I said, sometimes the sell-offs are strong enough to make the market always in short, but still within a broad bull channel. That's one of the hallmarks of a broad bull channel. The market often has episodes when the market is temporarily always in short. We reversed up here, so I'll redraw the channel using this low. As channels progress, they tend to become flatter and broader. The original channel was across here, but we gapped below it, and now I would redraw the line there. We fell below this low, and I think this is a major higher low, as is this, but we did not fall below the bottom of the bull breakout. And this sell-off then, while it makes the market always in short, at least temporarily, it still does not convert the market into a bear trend yet. We're still above this higher low. The big picture at this point, the big picture is we're still forming a potential higher low after a higher high. And at this point, you got to be thinking, yes, we're in a trading range. We're in an early bear trend, but the bull channel still is alive. Is this really a minor higher low? You could call it a minor higher low because this is a much stronger higher low, but I would call it a major higher low. With this many bars up and the breakout to a new high, I think this is a major higher low. And we're also in a trading range, and in a trading range, the market often falls below the bottom of the range before reversing up. The important point is that when the market's in a broad bull channel, it can be very bearish at times, but those times do not last long before the bull trend reasserts itself. A broad bull channel I think of as a weak bull trend. It's barely better than a trading range. And during a lot of the time, it's in a trading range, like here and here. The flatter and the broader the channel is, the easier it is for bears to make money. When the market's in a broad channel like this, bulls and bears will place trades. It's okay to both buy and to sell. If the channel is very tight, you only want to look to buy. But when it's broad like this, traders will both buy and sell. As I said, one of the other characteristics of a broad channel is that it spends a lot of time sideways in a trading range. And traders trade it like a trading range. They buy and sell because most of the bars on this chart, even though we're in a broad bull channel, most of the bars are also in a trading range. Trading range, buy low, sell high, and scalp. The lines are far apart, so there's plenty of room for both the bulls and the bears to make money. Another characteristic of a broad bull channel is that a lot of the bars have tails on top, and a lot of the bars have bare bodies. And that's consistent with the market being very two-sided. Many bars overlap, lots of reversals, a lot of bad follow-through after good bull bars, good bull bar, bad follow-through, a few good bull bars, bad follow-through, bull reversal, bad follow-through, bull breakout, bad follow-through, bull breakout, bad follow-through. When you see bull legs that have bad follow-through, the market's either in a trading range or in a broad bull channel. Pullbacks are very obvious. They last many bars and they fall for a lot of points, often more than 50% of the prior bull leg. It simply looks like a trading range that is tilted up. And because of that, traders trade it like a trading range. They buy low, sell high, and scalp. This is a bear channel, and it's tight. The pullbacks are brief, only lasting a few bars, and they do not go up very far. On a high enough time frame chart, a tight channel like this is simply a breakout. This is a 5-minute chart. Here's a 60-minute chart, and it's a breakout. And because it's a breakout on a higher time frame chart, when you're trading the 5-minute chart, it's much easier to make money only selling. So it's better only to sell and not buy. If you buy, even with a limit order, look at this, you buy that low right here, you're going to lose money. The market never comes back above that low. Same here, buying a new low, you lose money. This is a bull channel, and it's very tight. Pullbacks are brief, do not fall many bars. Very difficult for bears to make money, even with limit orders. On a higher time frame chart, a tight bull channel like that is going to be a breakout. 5-minute chart, tight channel. 15-minute chart, it's a breakout. And because it's a breakout on the next higher time frame chart, it's better only to look to buy on the 5-minute chart. What do you think about this channel? Is it broad enough to sell for scalps? This is the euro versus the Japanese yen. Or should you only look to buy? A general rule, if you cannot decide if the channel is broad enough to sell, only look to buy. When you have a bull channel, it's always good to buy, and you can only sell if it's clearly broad enough to make money fairly easily. In a situation like this, where the pullbacks are only 10 or 15 pips, it's very difficult to make money selling. It's better only to look to buy. I'm going to talk now about bear channels, both tight and broad. Every channel is a trend, and every trend eventually has a channel, and every chart has many channels in it. The tighter the channel, the stronger the trend, and it's similar to a breakout. When you have a fairly tight channel like this, the pullbacks usually only last 1, 2, or 3 bars, and they usually do not retrace too much of the prior bear leg. You should only be looking to sell. Here, a tight bear channel. Pullback went up 3 bars or so, but really very difficult to make money buying when the pullbacks are relatively small like this and the channel is so tight. Better only to look to sell. This is a bear breakout, especially this strong bear breakout. But here, this bar goes above this high. This bar goes above this high. So this is a pullback, that's a pullback. That means that the market has evolved from a breakout phase, this whole thing is a breakout, into a channel phase. But the bulls are in control only briefly and intermittently. The bears keep reasserting themselves, and we keep getting lower lows and lower highs. Take a look at this chart. It's a 120-minute chart, dollar versus the yen. And what do you think about this chart compared to the last chart? It's a broad bear channel. The pullbacks last many bars, and they retrace much of the prior bear leg. It basically looks like a trading range that sloped slightly down, and a lot of the chart is, in fact, in a trading range. Bulls can buy for scalps. They can buy reversals up, they can buy prior lows, and look for scalps. It's a bear channel, so it's a bear trend. Bears will definitely sell as well. They'll sell for swings or for scalps. Again, all channels are trends. All bear channels are bear trends. And the broader the channel is, the weaker it is, and the more it's similar to a trading range. Another characteristic of a broad bear channel, the reversals up are often strong enough to make the trend always in long. Here, here, here. However, as strong as the rallies are, they're still largely making lower highs. This rally went above that high, but not above the top of this strong bear breakout. and the reversals down led to new lows. So it's predominantly lower highs and lower lows, even though there's a lot of overlap, even though the market is often always in long, and even though it does go above some of the prior lower highs. It's still mostly lower highs and lower lows. Major lower high, even though it did not go to a new low. Another major lower high, strong bear reversal down. It did go to a new low. This is, I think, a fairly minor lower high. Even though this low might be a little bit below that low, the sell-off is not all that strong. It's still significant that the rally went above it, and the market probably was always in long somewhere in here, but only briefly, and it turned back down below a more significant lower high. You look at that and you say, well, that's confusing, Ali. It's not convincing. Well, that's the point. When the market's in a broad bear channel, it has a lot of trading range price action, yet when you step back from across the room and look at the chart, the market is trending down. It's making occasional lower lows. The market's getting lower lows and lower highs. It's basically a trading range that's sloped down. And because of that trading range price action, traders can make money both buying and selling. Broad swings means a weaker trend, and it means it's much more two-sided. The broader and flatter the channel is, the easier it is to make money buying, even though it's a bear trend. So traders will both buy and sell when you have a broad channel, especially when it's flat like this. When a channel is reasonably tight and you're not sure if you should both buy and sell, it's better to only trade in the direction of the trend. If you have a tight bear channel, it's better only to sell. This is broad. You can trade both ways. The lines are far apart. The rallies have a lot of bars, 5 or 10 bars, and there are lots of swings up and down. Traders can both buy and sell. Another characteristic of a broad bear channel, a lot of the time, the market's in a trading range. So it's in a trading range here, a little bit lower, still a trading range here. And because broad channels spend a lot of time in trading ranges, you can trade them like trading ranges. Look to buy low, sell high, and scalp. Bear trend, but a lot of the bars have prominent tails on the bottom. Also, a lot of the bars have bull bodies and strong bull bodies. That's another characteristic of a broad bear channel. It's a weak bear trend. Traders will both buy and sell. A lot of overlapping bars. The market's not going down, even though it's overall going down on the screen. Much of the time, it's sideways, overlapping bars. Weak follow through after big bear bars. Big bear bar, bad follow through. Bear bar, bull bar, bear bar, bull bar, bear bar, doji. So a sell-off, but there are problems with the sell-off. Where are the consecutive big bear trend bars that you typically see in a strong bear trend? They're not present because this is not a strong bear trend. It has a lot of two-sided trading. Obvious pullbacks. Bear trend, but pullback very strong. In fact, it's a swing up. Again, it looks like a trading range that's tilted slightly down. Compare that with this. We got a bear microchannel, a breakout, and then we're starting to get pullbacks here and here. It's a bear channel. Is it broad enough to both buy and sell, or should you only sell? If you cannot decide, then assume that it's too tight to buy and only sell. Here's a 240-minute chart of the dollar versus the yen. Most trends begin with a breakout. Here it's a fairly good-sized breakout. Then we got a pullback. At this point, it's still below this high, so it still might be the early stages of a broad bear channel, but it's clearly enough of big down, big up to create confusion. It turned out it formed a lower high and then a persistent channel down. new low, big pullback. So at this point, you got to be thinking it might be a broad bear channel or a trading range. And it is both at this point. We have a spike down and then a broad channel. Spike and channel patterns, like all patterns, are often nested. And by nested, I mean there are often smaller patterns within the bigger pattern. Bear trend, there are a lot of breakouts along the way. There's another bear breakout here, and then here, and then here. Each leg, up or down, often contains smaller breakouts, and some of the best trends are seen on the smaller time frame charts. To me, this is a nested spike and channel trend. We got a spike here and then a channel. You can say this is a breakout on a higher time frame chart, so it's also a spike, pullback, and then channel. Bear spike, pullback, and channel. Fairly tighter channel within this broader channel. Bear spike, pullback, channel. Bear spike, pullback, channel. There are several nested spike and channel patterns here. Bear breakout, so small spike and channel. On a smaller time frame chart, this would be obviously a spike and channel bear trend. Very common to see nested patterns, smaller patterns within larger patterns. Another bear breakout and then a little wedge channel, so another spike and channel trend, again within this larger spike and channel bear trend. We have a breakout, a bear breakout, and then a channel. Breakout, you can call it a trend bar, you can call it a spike, and then pullback. Pullback starts the channel phase, so a spike and channel bear trend. When you have a spike and channel bear trend, so spike and pullback and channel, it's usually followed by a trading range. And at least half of the time, the top of the range is at the start of the channel. That is the target now for a rally, if we do get a rally here. A channel, bad follow through, strong bear bar, good bull bar, bear bar, bull bar, bear bar, bull bar. It looks like a bear leg in a trading range instead of a bear leg in what will continue down as a trend. And that's usually the case. When you see a channel and it has bad follow through along the way, it's probably going to transition into a trading range before long. And once it's in a trading range, you have to be thinking that we could get trend resumption down or trend reversal up. We can get a trend breakout in either direction. I think of a channel as a transition phase, a hybrid. It has characteristics of a trend and characteristics of a trading range. And it's usually part of the transition from a trend into a trading range. We have a strong bear breakout, so a very strong bear trend. And then we have a channel with bad follow through all the way down. On some higher time frame chart, it's tight enough to be possibly a breakout. But on this chart, bad follow through, bad follow through, bad follow through, bad follow through. It's probably in the process of transitioning into a trading range. And then we have a bull breakout above the channel, and we're probably in the early stages of a trading range. In this video, I talked about the different types of channels. They can be horizontal, like a trading range. They can be expanding or contracting, like a triangle. Or they could be rising or falling diagonally, like a bull trend or a bear trend. I then talked about tight and broad bull channels. And finally, I talked about tight and broad bear channels. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 6 videos on channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 6 videos on channels. I'll begin by talking about how channels evolve into trading ranges. I'll move on to talking about how most channel breakouts up or down fail. And finally, I'll talk about a width trend breakout of a channel. So if you have a bull channel, sometimes you get a bull breakout, If you have a bear channel, sometimes you get a bear breakout. As the channel progresses, bulls become less confident that the trend will continue, and they begin to take quicker profits. They begin to scalp. Also, bears begin to see that if they sell at the high of the prior bar and add on higher, they can begin to make profits. Bulls selling at new highs. Instead of buying new highs, confident that the trend will go up much further, they begin to take profits at new highs. So they buy a pullback and they begin to take profits at the prior high. They are beginning to think that the trend might not continue all that much further, and maybe this channel is the beginning of an evolution from a strong bull trend, a breakout, to a channel and then to a trading range. This is a spike in channel, spike, pullback, second push, pullback, third push. Most spike and channel patterns like this have 3 pushes, 1, 2, 3, and evolve into trading ranges. Typically, they work their way down to the bottom of the channel. And all channels, whether or not they're in a spike and channel pattern, usually have an opposite breakout and then they evolve into a channel. Remember the market cycle. You have a strong breakout, it weakens with a pullback, enters a channel, and then eventually becomes a trading range. And that is what happened here. So bull breakout, you can call it a spike, first push, second push, third push, a bear breakout below the channel. I don't have the trend line drawn in, and then a couple legs down, testing the beginning of the channel. And then the channel evolved into a trading range. Just like the bulls are losing confidence that the trend will go much higher, the bears also doubt that it will go much higher, and they therefore begin to sell above prior highs and scale in higher for scalps. The bear would sell over here, maybe add on here, and then take profits when the market came back to their first entry. And then they get out break even on their first entry, and then with a profit on their second entry. Again here, they sell here, sell more higher, and then buy back their shorts at the first entry. Break even on their first entry, and then a scalp on their second entry. Here's a bear channel. We have a bear breakout, big bear trend bar, and then a channel. 3 pushes down, 1, 2, 3, possibly a type of spike and channel pattern. Strong bear breakout, bears are selling pullbacks. Every pullback they see as a bear flag, and they'll sell below the low of the prior bar. They'll get filled here. Usually higher probability to sell below a bear bar. So a lot of bears, instead of selling below that bull bar, will sell below this bear bar and get filled here. Here they'll sell either below that bar or below this bear bar. Again, below a bear bar, expecting at least a new low. The bears, instead of selling at new lows, they're taking profits at new lows. That's why we're getting these reversals up. New low, and the market goes up. The bears are not selling there, they're buying back their shorts. They're losing confidence that the trend will continue much further. They think that the channel might soon evolve into a trading range, and therefore you get a stairs pattern. Every breakout, here's a breakout point. The market comes back above the breakout point. We have a breakout. The market continues down a little bit, but comes back above the breakout point. That's a stairs pattern, and it's usually a sign that the channel is weakening and will soon evolve into a trading range. Very often when you have a spike and channel bear trend like this, before the market gets all the way up to the top of the channel, it'll go sideways around halfway up and then decide whether to resume down or retrace all the way to the top of the channel and then form a trading range. The bulls also see what's going on. They see that when the market goes to a new low, there's buying going on. They know the bears are not selling that low. They see the bears are taking profits. And that gives the bulls confidence that the trend will not continue down much longer. And they begin to buy at the prior low and scale in lower for scalps. They place a limit order to buy at this low, and then they'll buy more. Usually the size of the minimum scalp lower. So if it's a Forex chart, the minimum scalp is 10 pips. They'll buy here. If it goes up 10 pips, they scalp out. If it instead first goes down 10 pips more, they'll buy more and then get out at their first entry, break even, and then with 10 pips profit on their lower entry. Most bear channels, here's a bear channel. We have a bear breakout, a spike, and then a pullback. That's the start of a channel. Most bear channels have bull breakouts. And therefore, even if the market is in a bear trend, a bear channel is a bear trend, traders should look at bear channels and see them as bull flags because most have a bull breakout. And the same is true for bull channels, whether or not it's a bull channel in a bull trend or a pullback in a bear trend. Traders should see them as bear flags and expect a bear breakout. We have a bear trend, bear breakout, and channel. However, I always think of it as a bull flag because the odds are it's going to have a bull breakout. Bear channel, bull flag, because probably we'll have a bull breakout, which it did here. Here we have a strong bull breakout, and then a pullback, and then a channel, overlapping bars, some bear bars, pullback, pullback, pullback. So it's a bull channel. It's a bull channel and a bull trend. However, the odds favor a bear breakout. Whenever I see a bull channel, I always think of it as a bear flag, even though it's not a bear flag. It's a bull channel and a bull trend. The odds are it's going to eventually get a bear breakout. Bull channel, bear flag. And we got a bear breakout below the bottom of the bull channel. So spike, pullback, channel, probably going to be a bear breakout. And then we have a trading range, the market cycle. Breakout, channel, and then trading range. This is a very strong bull trend. It's in a channel. It's probably a breakout on a higher time frame chart. This is the dollar versus the yen, a 5-minute chart. However, 75% of the time, if you have a bull channel, even if it's tight, strong, it'll have a bear breakout. Only 25% of the time will it get a bull breakout, and the market cycle then begins over again. Breakout, and then another channel, and eventually a trading range. As strong as this bull trend is, we got a bear breakout. The bear breakout was not a bear trend. It was a sideways tight trading range, and that is common. But it's still a bear breakout. Here's the bull trend line, the bottom of the channel. And by the market simply going sideways, it broke below the bottom of the channel. Again, we have a bull channel, a bull trend, and we're starting to get a bear breakout. This bull channel had a bear breakout by going mostly sideways. It went down a little bit, but it was mostly sideways. And it entered a trading range, market cycle. You have a strong bull trend here, a pullback, a strong bull trend here, pullback, and then a channel. And channels usually evolve into trading ranges. Sometimes it's a tight trading range. Sometimes the channel goes all the way down to the bottom of the channel here or here, and then enters a trading range. Once the market's in a trading range, 20 or more bars of sideways to down trading, it enters breakout mode. And at that point, it has just about the same chance of trend resumption up as it does trend reversal down. In general, if you have a trading range and a bull trend, the odds are slightly higher that you'll get trend resumption up and slightly lower that you'll get a trend reversal down. But at some point, if the trading range grows to 20, 30, 40 bars, the probability becomes the same for a resumption of the bull trend or a reversal into a bear trend. The bulls see a trading range as a double bottom bull flag. The bears see the trading range as some kind of a major trend reversal, like here, a double top, lower high, major trend reversal. Bull breakout, pullback, and then you expect a channel. Now, you expect a bear breakout, and then the evolution into a trading range. Sometimes, however, you get the bear breakout and it begins a bear trend. Here we have a breakout, not particularly strong. Some follow-through selling, not particularly strong, but it just kept going on and on and on for 40 or 50 bars. So we have a wedge top, 1, 2, 3, 4, and then a bear breakout. This is the give-up bar, the breakout bar, and then an endless pullback. After some point, after 20 or 30 bars, you have to conclude that it's a bear trend and not simply a bear leg in a developing trading range. A lot of times with these wedge tops, the second leg is very strong and traders start the count over again. So instead of 1, 2, 3, they say 1 and then, oh, strong bull trend, maybe 1, 2, 3. Another way to look at it is a wedge, 1, 2, 3, that broke to the upside. If you have a wedge top and a bull breakout, 50% of the time you'll get a stronger trend up. 50% of the time the breakout will fail, and then the wedge top will lead to a reversal down. Gap. So there's a spike here, even though you do not see it. I think of a gap as an invisible trend bar, and then 3 pushes down, 1, 2, 3. It's a bear channel, and it's converging, so it's a wedge bear channel. And like all bear channels, 75% chance you're going to get a bull breakout above the bear trend line. If it's a wedge bottom and the shape is pretty good, instead of simply an evolution into a trading range, you can get the start of a bull trend. Here we started to evolve into a trading range, but then we got a pretty good bull breakout. We tried to form a trading range here, but we just kept going higher. Is the whole thing a trading range? Yes, it is, but you can also call it a bull trend. We got 3 pushes up, 1, pullback 2, pullback 3. After a wedge bottom, 1, 2, 3, we have a wedge rally, 1, 2, 3. It went above the top of the bear channel and formed a double top, this high and that high, and it evolved into a trading range. Is this a bull trend, or is it simply a bull leg in a trading range? You can call it a bull trend. It went up a lot of bars pretty fast, but you can also call it a bull leg in what became a trading range. We have a very tight bear channel. It's a breakout on a higher time frame chart. You could simply call this the breakout, and you could say the channel began here. But we have a fairly tight channel and then a bull breakout above that tight channel. So you can say that the channel began here. Doesn't matter. It's still a fairly tight bear channel, trying to get a bear breakout, but you know that even a tight bear channel, 75% chance you're going to get a bull breakout. It can break to the upside either by going sideways or by going up. So every bear channel, no matter how tight, no matter how strong, I think of it as a bull flag, because the odds are you're going to get a bull breakout. Here we went sideways for a few bars and then eventually worked higher and got a bull breakout above the top of the bear trend line. Most channel breakouts usually fail. Bear channel, and we try to break below the bottom, and we get a micro double bottom, down and up, down and up. This looks like a potential failed breakout below a bear channel. When you do get a breakout above or below a channel, the breakout usually fails within about 5 bars, and 75% of the time it fails. I always look at the highest time frame chart that shows the channel. For example, let's say this is a 5-minute Forex chart. If I looked at a 1-minute Forex chart, these 2 bars would be 10 bars instead of 2 bars. And therefore the failed breakout would be occurring in 10 bars. However, I always look at the highest time frame chart that clearly shows the channel. And on that chart, 75% of the time, the breakout will reverse up within about 5 bars. Breakout below a bear channel, and we reversed up, and we reversed up a second time. It looks like the bear breakout is failing, which it did. We're testing the top of the channel. Is there a 75% chance the breakout of the top of the channel will fail? In general, yes, but if it's following a reversal up from the bottom of the channel and the reversal up is strong, the chance that the breakout above the top of the channel will fail is much less. To me, I'm assuming that this is the start of a new trend and that the channel phase is over. The bear channel has ended. The goal after a failed bear breakout below the bottom of a channel, the test of the top of the channel. That's the minimum goal. Here, we got much more than that. We got a breakout into a bull trend. A breakout into a bull trend, you have to assume the market cycle is starting over again. So bull breakout, and then we'll get a pullback, and then a channel. Here, let's say we're looking at this chart, and we're getting a bear breakout below the bottom of the channel, yet the bear breakout is continuing. And that is far more than 5 bars before the breakout fails and reverses up. This is a 2-minute chart, and it took 30 bars before the bear breakout failed and reversed up. However, I'm always interested in the highest time frame chart that shows the pattern. And if you look at this, this is exactly this chart. This is a 2-minute chart. This is a 30-minute chart, and it shows the same breakout, and the reversal up occurred within 3 bars, 1, 2, 3. So bear breakout, and the bear breakout failed within 5 bars. In this case, it failed within 3 bars. Always look at the highest time frame chart that shows the pattern. 75% chance that the bear breakout will fail within about 5 bars and then test the opposite side of the channel. The minimum goal when you have a reversal from one side of the channel is a test of the opposite side of the channel. That's the minimum goal. We have a breakout here, and then a bear bar, a pullback, so maybe the start of a channel, and we did get a channel. And here we have a bear breakout below the bottom of a bull channel. Does that mean you're going to make money if you sell the breakout below the channel? No, not at all. When a channel is very tight like this, the chance of making money selling is small. Expect that any reversal is going to be minor, and it's very difficult to make money betting on a minor reversal. Just because you know the odds are it's going to break below the bull trend line does not mean it'll go far enough down for you to make money selling. When there's a very tight bull channel, it's a very strong bull trend. It's better only to be looking to buy. Trying to reverse down after about a 10-bar bull micro channel, chances are the bear reversal will become a bull flag. Traders will look to buy on a stop above a bull bar on the reversal up. They'll buy above the high of any bar on the reversal up. In fact, traders will buy below bars, betting that the reversal down will fail. I said that 75% of breakouts of channels reverse, but sometimes they succeed. If you have a bull channel, sometimes you get a successful bull breakout. If you have a bear channel, sometimes you get a successful bear breakout. And then the market cycle starts over again. Breakout, new channel, and then trading range. We have a bear channel, wedge shape, but it looks like we're trying to get a bear breakout. 75% chance a bear breakout or a bull breakout of a channel is going to fail within about 5 bars. Here, we're trying to get a wedge bottom, 1, 2, 3, and we're trying to reverse up. The reversal up failed, and some bulls will put stops below this bar. Whenever you have a wedge bottom, or any kind of a bottom where there's a clear place for a stop, and then the stop gets hit, half of the time you'll go down for a swing, half of the time the bear breakout will fail and the market will reverse up. In this particular case, we broke out, and we broke out a second time, and we created a bull IOI. We have a bull inside bar following an outside bar. So a second entry buy. Some traders would buy above this bar. Other traders would say a single bull bar is not enough to reverse such a big bear bar, chances are you'll get at least a small second leg down. The bear's got it here. Then this is a second failed bear breakout. This is a higher probability buy, looking for a test to the top of the channel. Think about what's happening here. We have a reversal up, reversal up. You can draw a line, 1, 2, and then you wait to see what happens on the third test of the line. And we tried to reverse up, but not a particularly good reversal. We have 3 decent bear bars here. And then look what the bears did next. A very strong bear bar. The bears are trying to get a bear breakout below a wedge bottom, hoping for a measured move down. But look at the follow-through. Terrible follow-through after a bear breakout. Strong enough bear bar to expect at least a small second leg down. And the bears got their minimum, a small second leg down. And look at that follow-through, another big bull bar. This is probably going to be a failed breakout below a wedge bottom. And the minimum objective would be some kind of a reversal up, probably with 2 legs up. Here's the first bear breakout. And most bear breakouts below channels fail. And usually the reversal up occurs within 5 bars. Here it occurred within 6 bars. 1, 2, 3, 4, 5, 6. Micro double bottom, down, up. Bull bar here, bigger bull bar here. The bear breakout below the wedge bottom looks like it's failing. This is a reasonable buy, looking for at least 2 legs up. 1, pull back, 2. Here we have a bull channel, fairly tight bull channel. We have a bear breakout. And now it looks like we're trying to get a bull breakout above the top of the bull channel. Only 25% of the time will you see a successful breakout above a bull channel. This is an example. 3 consecutive bull bars closing on their highs, good sized bodies. This is a breakout, and it appears that it's going to be successful. We have some hesitation, and then you can call this a channel. So spike, and then pull back, and then maybe channel, and then eventually a trading range. Because there's a bull breakout, you have to be thinking that the market cycle is starting over again. So breakout, and then channel, and eventually a trading range. In general, after there's any kind of a breakout or a reversal, traders expect about 10 bars and 2 legs as their minimum objective. So bull breakout, and then pull back, and second leg. This breakout is so strong that it may have a second leg up. Bull breakout, pull back, and maybe 1 more leg up. Don't know. But the minimum objective when you have any kind of reversal or any kind of a breakout is 10 bars and 2 legs. We've got a bear channel, 2 reversals, draw a line. The market reversed up again at that line, but then it did this. 3 consecutive bear bars closing below their midpoints, 1 closing on its low. Decent sized bear bodies, especially compared to the size of the bull and bear bodies here. This looks like a breakout, and a breakout, you have to be thinking market cycle, breakout, pullback, and then channel. Only 25% of the time when you have a bear channel will you see a successful breakout below the channel. A breakout begins the market cycle over again, so you think breakout, pullback, channel, and then eventually trading range. Minimum objective, 10 bars, 2 legs, sideways to down. 10 bars, 2 legs, TBTL. We have 1 leg down here, maybe 1 leg down here, and then pull back, and then second leg down. Bear channel, 2 reversals, draw a line, reversed up here, broke below it, reversed up, reversed up, reversed up. So it looks like it's respecting the bottom of the channel. Bear channel, bull flag, 75% chance this bear channel is going to evolve into a trading range. Only 25% chance will the bears get a successful bear breakout and then another bear channel. This is an example of that 25%. I like to see consecutive big bear bars. Big bear bar, follow through big bear bar. When I see that, I think of it as the market cycle starting over again. Breakout, and then pull back by going sideways, and then channel down. So instead of a bull breakout of the bear channel, we got a bear breakout below the bear channel, and the market cycle starts over again. Breakout, pullback, and then channel, and then eventually a trading range. Breakout and then channel. You expect a bull breakout, which the market gave us by going mostly sideways. Not a bull trend, simply a sideways breakout above the top of the bear channel. Trading range, so market cycle, bear breakout, channel, and then evolution into a trading range. After about 20 bars, breakout mode, the probability of a reversal up becomes about the same as the probability of trend resumption down. This is the 1987 crash. I began trading right before that, and this was a devastating emotional shock to everyone who was trading at the time. It was interesting, on that day, I was short 13 S&P 500 futures, which is now the equivalent of 5 times that, 65 E-mini contracts. The price is much less, but it's the equivalent of 65 E-mini contracts. And I had to go to the office to do surgery that day, eye surgery. And I got out. I actually lost, I think, $5,000 on the day. Had I stayed and traded and just held until the close, I would have made $400,000. And that's in 1987 dollars. That would be about $1 million in today's dollars. In any case, what I'm trying to illustrate here is we have a channel, 75% chance you'll get a bear breakout and then the evolution into a trading range. But there's a 25% chance you'll get a bull breakout and then the start of a new market cycle. Look what happened. 4, 5, 6, 7, 8, 9, 10 consecutive bull bars closing on their highs. This is a strong breakout, and it's well above the top of the bull channel. This is one of those cases, one of those 25% of the time when you get a bull breakout above a bull channel and the market cycle starts over again. This is 1995, after the Republicans took over the House of Representatives in 1994. 8 consecutive bull bars closing on or near their highs. Very strong bull breakout. Chances are we're going to get some kind of a measured move up. It's a low probability event. It should not have happened. Chances are we were going to get a bear breakout below the channel. Instead, we're getting a bull breakout. And not only a bull breakout, an exceptionally strong bull breakout. You cannot deny it. You have to look at that and say, that should not be happening. When something happens that should not be happening, there's going to be strong follow-through. Here's that same chart, but zoomed out. Here are those 8 bear bars on the monthly chart, and the market just kept going up. It turned into an 18-bar tight channel. We started to get pullbacks, but it's still in a very tight channel. And we have a pullback here, and this is what followed. The S&P went from 400 to 1,500 over the course of the next 5 years or so. We had a bull channel. You expect bear flag, bear breakout. When you get a bull breakout, especially if it looks particularly strong, you're probably going to get good follow-through. This is unusual. However, you cannot deny it. Once you start to see 5, 6, 7, 8, 9, 10 bull bars breaking above the top of a bull channel, you have to assume that the market has changed. Here we got a 300% gain in the S&P over the next 4 years. Bull channel, usually you get a bear breakout and then a trading range. But here we have a bull channel and we got a bull breakout. So the market cycle starts over again. Very strong bull breakout, micro channel, little pullback, very tight channel. And then a bigger pullback, and then more bear bars and more pullbacks. Very tight bull channel, a breakout on a higher time frame chart. We got a bear breakout below the bull channel, but look what happened. It reversed up strongly, and you could then draw a broader bull channel. New market cycle. Whenever you get a bull breakout, you got to be thinking about a new market cycle. Breakout, and then channel, and then eventually a trading range. Clearly a very strong bull breakout here. But in fact, You could argue that this entire rally for 3 years is the breakout. This is a monthly chart. If you looked at a higher time frame chart, like every bar being 6 months or every bar being 1 year, this entire 3-year rally would probably be simply a strong bull breakout. And this is a big enough pullback, you'd think that the channel began right here. And market cycle, breakout, pullback, and then a channel, and then the channel gets a bear breakout, and then the market evolves into a trading range. Again, remember, we had a bull channel here after the 87 crash, and then a very strong bull breakout. A low probability event. Whenever a low probability event happens, you get bulls trapped out. They're in denial, they don't buy. You have bears trapped in. They're selling above the bear channel, betting that the breakout will fail. So both are trapped, and both are hoping for any kind of a pullback. The bulls want to pull back so they can finally buy, and the bears want to pull back so they can exit with a smaller loss. The result is the first reversal down, traders will buy it. Bulls will buy it to get long, bears will buy it to exit losing shorts. Minimum goal, 2 legs up. Is this the first leg, pullback, second leg? Well, you could argue it is. You could also say that if you're using different time frame charts, first leg up, pullback, second leg up, doesn't matter. Minimum goal is 10 bars, 2 legs. We got far more than that on the monthly chart. On a higher time frame chart, like a yearly chart, this whole thing would be the breakout phase, and this would be the pullback. Leg 1, pullback, leg 2. Whenever there's any kind of a pullback, here we have a pullback, I look to the left to see if it stays above the breakout point, which it did here. So you got to be thinking that maybe this gap between this low and that high is a measuring gap. I'll look at the start of the move and then the top of the first leg and project up for a measured move, knowing that a lot of bulls will begin to take profits there. Aggressive bears will short there, but when a channel is this strong, it's better only to be looking to buy. Here's that same chart, the 87 crash. At the time, it was huge. The market fell 25% in one day. But when you look back now, so many years later, 30 years later, it looks minor. In any case, we have a bull channel and then a bull breakout, and then we have another bull channel, and this bull channel did get a bear breakout. In fact, this was a devastating correction. It's a loss of about 50%, and it's about a 50% pullback from this rally. This is the spike pullback channel. We have a bear breakout below the bull channel, which happens 75% of the time, and then the market typically comes down to the bottom of the channel. Here we went a little bit below. Bull breakout, pullback channel usually evolves into a trading range. And this trading range lasted 15 years. And eventually we got trend resumption up. Here's the dollar versus the Canadian dollar, a 480-minute chart. We have a bull breakout, and then a pullback, and then a channel. 75% chance, bull channel, bear flag. 75% chance we get a bear breakout and the evolution into a trading range. 25% chance we get a bull breakout and the market cycle starts over again. And that's what happened. Bull breakout, channel. Instead of a trading range, you can say that this is a trading range, but you can also say it's still a bull channel. We got a very strong bull breakout. 25% of the time, that's what happens. You get a bull channel and you get a bull breakout, and the market cycle starts over again. Breakout, a pullback, and then channel, and then eventually a trading range. After any breakout, a very strong trend, you expect a pullback and then a channel, a weaker trend, and then you expect that channel eventually to evolve into a trading range. That is the market cycle. That's how markets typically behave. Bull breakout, pullback, a channel, a broader channel, and then eventually a trading range. And after the trading range, especially one that lasts 40 or 50 bars like this, 50-50 chance there'll be trend resumption up. The bulls will see a triangle or maybe a double bottom bull flag, and the bears will see a major trend reversal, like a double top, lower high major trend reversal, and they'll look for trend reversal down. Market cycle. Bull breakout channel, maybe trading range, or maybe just bull breakout channel, and then bull breakout again. 25% of the time you get that. The market cycle starts over again, bull breakout channel, and then trading range. And then the market waits for a breakout up or down, and then the market cycle will start over again. Bull channel, so bear flag, but then we got a strong bull breakout, so you have trapped bulls and bears. Bulls were hoping for evolution to a trading range that would allow them to buy lower, so you have a lot of bulls who are trapped out, and you have bears who have been selling every new high, betting that the market would evolve into a trading range, and they are trapped in. And both are hoping for any kind of a pullback, even a small one, so they could buy. The bulls buy to get long, the bears sell to exit with a smaller loss. And because you have bulls and bears eager to buy after this kind of a strong breakout, you usually get at least a small second leg up. Here is what could have been the top of the channel and the start of a trading range. Instead, we got a bull breakout. I'm always looking at measured move targets. I might look at a measured move based upon the bottom of the channel to the top of the channel, or the top of the channel here. And if the breakout is strong enough, then I'll look maybe at the bottom of the entire pattern to the top of the entire pattern and look for a measured move up. And you can see traders started to take profits at that measured move target. Very strong bull breakout. Did the channel begin here? Maybe. Maybe it just rounded up and accelerated up. Is this a strong bull breakout and then a pullback that lasted 15, 20 bars and then the channel began? Some computers see it one way, other computers see it the other way. I tend to think of this as part of the channel, that the channel began either here or here, and it's a horizontal channel. If the pullback goes sideways for 20 or 30 bars, then the probability of trend resumption up drops to about the same as the probability of trend reversal down. Here, we lasted about 15 bars or so. I still think the probability favored trend resumption up. I said that whenever you have a bull breakout and then a channel, maybe this is the channel, only 25% chance of a bull breakout. However, if the channel is not clear and it's mostly horizontal, the chance of a bull breakout is much higher than just 25%. It's probably closer to 50%. This becomes more of a trend resumption, trend reversal setup. So bull breakout, pullback. Is this a channel? Is it a trading range? I don't know. But the flatter it is, the more the probability is that there'll be a 50% chance of trend resumption up, a bull breakout above the bull channel, and not just a 25% chance. A bull channel, but pretty flat, and therefore, instead of a 75% chance of a bear breakout, it's probably closer to 50-50 that you'll get a bear breakout or a bull breakout. In this video, I talked about the evolution of channels into trading ranges. I made the point that 75% of channel breakouts up or down fail, usually within 5 bars. However, 25% of the time, you'll get a bull breakout above a bull channel or a bear breakout below a bear channel, and then the market cycle starts over again. Breakout, new channel, and then trading range. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 6 videos on channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 6 videos on channels. This video has many smaller chapters to it. I'll begin by talking about limit orders. that you can use to fade tests of the top or bottom of a channel. I'll move on to talk about how breakouts typically start trends. Next, I will discuss reversals and breakout failures. Then I'll talk about broad channels and trading ranges. If you cannot tell whether or not the market's in a broad channel or a trading range, it does not matter. You trade them the same. You buy low, you sell high, you scalp. Finally, I'll make the point that every trading range has both an early bull trend and bear trend within it. Here we have a big bear bar and then a second reversal down. Traders will draw a bear trend line across the top and watch what the market does when it gets near the line. We have a reversal up, a second reversal up. Traders will draw a line and then watch what the market does when it gets near the bottom of the channel. We reverse down and then we have a second reversal down, a micro double top. The market reversed down from near the line and then it went up again and it reversed down a second time. So it's a micro double top. The market went up and down on this bar and then up on this bar and it's starting to go down on that bar. So it's a second entry short. The first entry is the market falling below that bar, and then the second entry is falling below this bar. Traders should be looking to sell on a stop below the low of this bear bar. The bear bar has a decent sized body and closed below its midpoint, and it'd get filled right here, just below the low of that bar. Incidentally, this is an II pattern. This bar is inside that bar, so consecutive inside bars. It's also an IOII pattern. We have an II, and then this bar is an outside bar. It simply means the market is deciding whether to break to the upside or reverse to the downside. This bear bar closing near its low, especially at resistance at the top of the channel, makes it more likely that the bears will get a downside breakout. The bears broke below the bottom of the channel, but on this bar, the market reversed up. It tried to break out again to the downside, but by the time the bar closed, instead of being a bear bar closing on its low, it's a bull bar closing near its high. Bulls would buy either above the high of this bull bar or above the high of both bars, using a stop, expecting at least a test of the top of the channel. The context is good here for a reversal, and experienced traders might enter with limit orders as well, and they'll be willing to scale in, betting on a reversal. They'll use wide stops. For example, as the market's falling here, they'll be able to draw this line, and they know the potential bottom of the channel is here, so they'll place a limit order to buy in this general area. They'll get long when the market falls just below their limit order. If it falls the distance of a scalp, a minimum scalp lower, a lot of traders will add on. The second entry, you want it to be at least the size of a scalp below the first, so that if the market reverses back up to the first, you can scalp out on the second and make a scalp profit, get out break even on the first. If the context is good, you do not exit either and you hold for a test of the top of the channel. Most trends begin with a breakout, even though sometimes the breakout is not conspicuous. Reversal down, I can draw a line. Reversal up, I could draw a line there, but we fell below it, reversed up again. So I would replace that first line with this line. It's a channel, and it's convergent. It's a wedge. And look at the rally. Where are the consecutive big bull trend bars? The bulls had good bars here, but worse bars here, and even worse bars here. This rally is probably a bull leg and what will end up as a trading range. The odds are there'll be a bear breakout below the channel, and then the market will go sideways. Traders will expect this bull breakout to fail. The channel up is not very strong. Some bulls will draw this line, and then when the market's going up, they'll place a limit order to sell at the line. And some will be willing to scale in higher if the market goes higher. Most bull trends, in fact, most trends bull or bear, end with a failed breakout. Here we have a bull trend. We're trying to break above the top of the channel, but we have a tail and not a particularly big bull bar. Look at the follow through after this bull bar, a bear bar. Bad follow through. The context is pretty good for the conversion of a bull trend into either a trading range or a bear trend. Do I want to be buying with a limit order at the bottom of the channel? Not really, especially after 3 consecutive bear bars. If the context is good for a reversal and a conversion from a bull trend into either a trading range or a bear trend, do not place a limit order to buy the bottom of the channel. We have a wedge top, weak rallies here, and now 3 consecutive bear bars. The odds are the market's going to begin to convert into a channel or even a bear trend. Look what happened here. After the 3rd consecutive bear bar, we suddenly get a very big bear bar. Not only that, look at the open of this big bear bar and the close of that bear bar. A lot of traders, when they see a reversal and they see 3 consecutive bear bars, they'll sell at the market. As soon as this bar closed, there were so many orders to sell at the market, the next bar opened below the open of that bar. That's a sign of very eager bears. And by the close of the bar, we had a very big bear trend bar. That means that bulls gave up. They were not buying at the bottom of the channel because they no longer think it's a bull trend. They think it's either going to have a couple legs down and form a trading range or a couple legs down and form a bear trend. A big bear trend bar like this on a reversal, I call it a give up bar. The bulls are giving up. And if they're giving up, they're not looking to buy a bar or two later. They're going to wait for at least a couple legs down. Wedge top, 3 consecutive bear bars. Chances are the bull trend is ending. Bears could sell with a stop below the low of the 3rd bear bar, and a lot of traders did. That's why this bar looks this way. You could also sell the close of the big bear trend bar, betting that traders now all agree that we're going down for at least a second leg. And therefore you can sell that close, stop either above here or above here, betting that the first reversal up will fail. The bulls who bought here and bought more lower are hoping to get out without a loss. They're going to sell, and the bears are going to sell as well. The bears who did not sell here suddenly now believe the market's going down. They'll look for any reversal up to sell. They can sell above this bear bar, a bad-looking buy signal, and they can also sell below this bear bar. Bull bar here, so we tried to go up, and bear bars went down. Bull bars here tried to go up a second time, and this bear bar tells me that the reversal up is going to fail. It's a double top bear flag, up, down, up, and you have a bear bar closing on its low. The market became always in short with this big bear breakout far below the bottom of the channel. Chances are we're going to get at least a second leg down. The market reversed down. It reversed down a second time. Traders could draw a line across those 2 highs. The market went above that line and now is reversing down again. So at this point, traders would replace the first line with a new line using these highs. To find the bottom of the channel, they can create a parallel of this line and drag it to the low point in between or to any of these other prior lows. Some traders will draw all 3 lines using this low, this low, and they'll watch how the market behaves. When the market got down to the line, it reversed up. When it tried to break to the downside again, it reversed up a second time, both times with bull bodies. Very strong sell-off here, but is this a strong sell-off or this? Much less so. This looks like a trading range through here and then a trading range through here. This is not a strong bear trend. It's a spike and channel bear trend. So very strong bear breakout and then a channel, and the channel down spent a lot of time going sideways. This bear channel probably will end up being a bear leg in a trading range or the final leg in the bear trend. Traders will look to be buying a reversal up from the bottom of the channel. And here we have a micro double bottom with 2 bull bars. Should you be selling at the bottom of the channel betting on a successful bear breakout? Well, only 25% of the time are you going to get a successful bear breakout below the bottom of the channel, and that's even less likely when the channel is as weak as this. Instead, traders should be looking to buy with limit orders at the bottom of the different channels. As I said, you can draw channels connecting these lows. You can draw channels with a parallel, anchoring it to that low, to this low. Traders will look at any of those lines and look to buy with a limit order. Experienced traders will buy with a limit order, buy more lower. Most traders should only be entering with stops, either above this bull bar or above both bull bars. A micro double bottom. Down, up, down, up. By the way, this is a second reversal down from the top of the channel. If we draw a line from this high to that high, the market reversed down. The bulls again tried to break above the line and failed a second time, so that is a reasonable short. Most channel breakouts fail. Should you be selling with a limit order in this particular case? At the top of the channel, betting on a failed breakout? Well, this is a special case. We have a spike, pullback, channel, probably will convert into a trading range or a bull trend. I would not be selling this high, expecting the rally to fail and reverse down again, especially when you have a micro double bottom and you see this bar going up very quickly like this. I would not be selling that, betting on the top of the channel leading to a reversal down. Context is good for a bottom, a weak bear channel, and a good reversal. And then we have a very big bull trend bar. What's going on here? Is this bear selling at the top of the channel? Of course not. It's bulls giving up. Bulls deciding that it's a spike and channel bottom with a good reversal. Chances are we're going to have at least a couple legs up. The bears are giving up. They're not selling here, and the bulls are buying, expecting at least 2 legs up. A big bull trend bar early in a possible trend. It's a give up bar. The bears are giving up, and it increases the chances that we'll get a rally, at least a bull leg in a trading range, possibly a bull trend. Most bear trends end with a failed breakout below the bottom of a channel. We broke out, it failed. We tried again to break out, and it failed the second time. I know it does not have a wedge shape. It doesn't matter. You could make it a wedge shape using this low and that low, and it would have more of a wedge shape. It doesn't matter. The key point is it's a weak bear channel, probably a bear leg in what will become a trading range or a bull trend. Plus you have a micro double bottom. So the context is good for a swing up. Do not sell at the top of the channel. It's a strong bottom, good context, and you have a big bull trend bar closing near its high. And you have good follow through as well. Instead of selling, you should be buying either the close of this breakout bar or the close of the follow through bar. You can also buy pullbacks. We have a bear bar pulling back after this 2-bar breakout. Traders can buy on a stop above its high, and same with here, and same with here. You can also buy with limit orders. We have a bear II, possible failed breakout, possible low 2, low 1, low 2, but strong enough bull bars, odds are buyers below that this is a bad sell signal. So traders will place a limit order to buy at the low of that bar, and they'll get filled right there. You can draw lines. You're seeing reversals down, lower highs, lower lows. You can draw that line. For the bottom of the channel, you can always create a parallel and drag the line to one of these lows or possibly even here to create a broad channel. You can also draw a line connecting lows on the way down. Different ways to draw channels, that's always the case. You never know which one most computers are using until you see a reversal up. Look at this bear bar. It's a very big bear bar. Not only is it a big bear bar, where is the last time the bears have had a bar that looks like this? More than 20 bars away. In fact, in the entire 50 or 60 bars of the bear trend, no bar is as strong as that bear bar. Whenever I see the biggest bear trend bar occurring 20 or more bars into the trend, what do I think is more likely? Is it the start of a new, even stronger bear trend, or is it an exhaustive end of the trend? It's more likely an exhaustive end of the trend. We're also down around a measured move based upon the height of this bull reversal, and that is a support level. Theoretically, you have a big bull bar. Theoretically, there'd be bulls buying here for a double bottom. There were not. If we break to the downside, it's basically a failed double bottom, and the market often falls for a height equal to the height of the neckline of the double bottom. So bottom should have been a second bottom. This would have been the neckline. Traders would look for a measured move up. Instead, we got a bear breakout below the potential double bottom. Traders look for a measured move down. The gap between this close and that low probably will close. It did close right here. This high went above that low. So this big bear trend bar, instead of being the acceleration of the trend into an even stronger bear trend, more likely it's an exhaustive end of the trend, which it was. Most sell climaxes, exhaustive sell climaxes, are followed by trading ranges, not by bull trends. But once you have the trading range, then the bulls can get a reversal up, which they did here. It would be unlikely for the market to fall like this and then reverse up here. It usually has to evolve into a trading range to stop the selling, and then the bulls have a chance at a reversal up. And notice where it's taking place, at the bottom of a channel. Obvious bear trend line, and then a parallel here. Or you can draw a channel line using these lows. In any case, it's a failed attempt by the bears to break below the bottom of the channel. It reversed up a little bit here, and it reversed up a lot there. Gap between the close of the big bear breakout and the low of the prior bar. And traders will buy. They'll buy the first reversal up, higher probability to buy the second reversal up. Here we have a double bottom, slightly higher low, but it's a double bottom, and a breakout from the double bottom, and this is a pullback. They'll buy that. Should you sell at the top of the channel? No, this is a pretty good reversal with two very big bull trend bars. More likely, buyers below the low of that bar. Bulls will buy the close of that bar. They'll buy the low of this bar. We got a small triangle, 3 pushes down, bear bar, bull bar, bear bar, bull bar, bear bar. So 3 bear bars, 3 sets of bear bars. So a triangle, and you have a bull bar. Traders will buy on a stop above the high of that bull bar and get filled here. I want to move on and talk a little bit about reversals and breakout failures. Different ways to draw the bottom of this channel. In any case, if the market is reversing up from the bottom of a channel, what's the minimum target? Well, the minimum target is for the market to go at least a little bit above the top of the channel. We're reversing down from the top of the channel. Minimum target is at least a little bit below the bottom of the channel. Different ways to draw the channel, so here, maybe here. The target was reached here. We got a little bit below the bottom of the lower line. Reversing up and reversing up again. What's the minimum target? At least a little bit above the top of the channel. And the bulls reached their target there, and you can see the hesitation, some profit taking at the top of the channel. Obvious bear channel, lower highs, lower lows, and we're getting a bear breakout. However, 75% of breakouts above or below channels fail. A bull breakout here, it failed. A bear breakout here, probably going to fail. Especially when you look at this big bear bar and then a bull bar, bad follow through. Bear bar, bull bar, bad follow through. Usually the breakout fails within about 5 bars. The biggest bear bar in more than 20 bars, in fact, the biggest bear bar in 70 or 80 bars, more likely an exhaustive end of the trend. Sometimes you get one more sell climax before you get the reversal. Big sell climax, a consecutive sell climax. The market probably will reverse fairly soon. gap, this close, that low, gap, this close, that low, this close, this low. All of those are probable exhaustion gaps, and the market will probably trade above all of those lows. It did over here, making this bear bar an exhaustion gap rather than a measuring gap. Traders expect this to be an exhaustive sell climax, a failed breakout below the bottom of a bear channel. They're looking to buy a reversal up. 3 pushes down, 1 and then bull bar, 2, then bull bar, and then 3. You have a bull bar here. They'll either buy above the high of this bull bar, or this bar closing on its high, they'll buy above that high, or they'll wait to buy consecutive strong bull bars, betting that it's the start of a swing up. Another bull breakout with good follow-through, they'll buy that. Here we have a pullback and a bull bar. They'll buy above its high and get filled here. Here the bears tried to reverse twice, 1, 2 at the top of the channel, and it failed. Traders will buy above the high of this bull bar, betting that the trapped bears will buy back their shorts. Reversal down from the top of a channel. Minimum target is a little bit below the bottom of the channel, and that target was reached. Reversal up from the bottom of the channel. Minimum target a little bit above the top of the channel, and the bulls reached their target here. However, it continued up much beyond that. This is a 15-minute chart of the euro versus the yen, and the target is at least 1 pip above the top of the channel. Reversal down, we can draw a line, and then expect a reversal down here. But look at this. We're getting a bull breakout above a wedge top. It's a wedge, 1, 2, 3, and we're getting a bull breakout. In general, if you break above a logical stop area, 50-50 chance you'll get a strong trend up, 50-50 chance the breakout will fail and you'll get a reversal down. I have the wedge drawn here, but here is a very strong rally. A lot of traders would say that the wedge began here, so this would be the first push, this would be the second push, that would be the third push. In any case, the market broke strongly above the top of the channel, but closed strongly down at the bottom of the bar. Chances are the market's going to have at least a couple legs down. Is this one pullback 2? Very tight bear channel. It's probably the first of 2 bigger legs. So 1 pullback and then 2 or 2. Most of the time when the market tests the top or bottom of a channel, it goes beyond. It overshoots the line before it reverses. Sometimes when it tries to test a line, it reverses up before reaching the line. That is an undershoot. Here we sold off. We went down and up, and then down and up. We have a micro double bottom, but it did not quite reach the line. That is an undershoot. The market cycle, you get a breakout, and then the trend weakens into a channel, and then the channel weakens and converts into a trading range, and then the market decides on the direction of the next breakout, up or down. We have a wedge channel and a strong bear breakout, 2 legs down, 1 pullback 2. You could even call this a spike in channel bear trend. Bear breakout, pullback, and then several steps down, and a bear channel, wedge bear channel. Even though it's a spike and channel bear trend, it's still a leg within a large trading range. Just like this is a strong leg up, but it ended up as simply a leg within a big trading range. This is the euro versus the dollar, a 5-minute chart. Most of the time, when the market tests a line, it goes a little bit above or a lot above before it reverses down. And this high went slightly above that line. That's called an overshoot. Examples of overshoots, I can draw a line. The market went above, reversed down. I can draw a line above. A bear trend line went above, reversed down. A bear channel line broke below, reversed up. So these are all overshoots. That is common. But sometimes you get undershoots. Here, I can draw a line, and the market reversed up without reaching the line. Here, I have a double bottom, and the market sold off strongly, but reversed up without reaching the line. That is an undershoot. Channel, it's an expanding wedge type of channel, but it's a channel. Channels usually evolve into trading ranges. We have a very strong bull breakout, a weak channel here. It tried to get stronger, 3 pushes up, and it evolved ultimately into a trading range. Market cycle. You got a strong bull trend and then a channel and a weaker bull trend. We're getting higher lows and higher highs, so it's a channel. And you'd expect a downside breakout and the evolution into a trading range, which is what we got. That's what usually happens. It's easy to confuse broad channels and trading ranges because broad channels often spend a lot of time going sideways. When you look at this, is this a bear trend, a bull trend, or a trading range? It's clearly a trading range, but look more closely at it. Getting lower highs, so it's actually the early stages of a bear trend. Lower lows, so it's clearly a bear trend as well as a trading range. Now, does it matter if you call this a bear trend, a broad bear channel, or a trading range? It doesn't matter at all because you trade them the same. You're going to buy low, sell high, and scalp. You're scalping because you do not expect any leg up or down to go very far. Even though it's a bear trend, the legs down are not much different from the legs up. It's not a strong trend. It's going to have repeated reversals, and it's better to trade it that way, scalp. Whenever the market is near a prior low and starts to reverse up, especially if it's a second entry, down, up, you buy. Higher probability to buy above a bull bar here rather than above a doji bar here. You could do either one though. Strong rally, but below the prior high, maybe a trading range, maybe a channel. Traders will look to sell. A low too short, low 1, low 2, bear bar. Some traders will sell this. Other traders will say strong pair of bull bars here, strong bull bar here. Wait for a second entry short, which is below that bear bar, and sell there. Same here, strong rally, not high probability taking the first entry short, higher probability taking a second entry, micro double top, and a lower high. You can call it a trading range, you can call it a broad bull channel, doesn't matter. The pullbacks are deep, they last a lot of bars. Bears will be selling rallies, at least for scalps. It's also a bull channel. Breakout, pull back a lot of bars, pull back a lot of bars, but higher lows, lower highs, and converging lines. It's a spike in channel bull trend. Clearly a trading range, but lower high and lower lows. So it's also the early stages of a broad bear channel. Every trading range has both buy and sell signals within it. Every trading range has both a bull channel and a bear channel within it. When you look at this, it's clearly a trading range. It's in breakout mode. However, you can say, wow, it's getting higher lows and it's getting higher highs. This is also a bull trend. It is a bull trend. If the market continues up here and you ask where the bull trend began, you would say here or here. So it's clearly in a bull trend. On the other hand, this low is below that low. This high right now is below that high. So it's also a bear trend. And if this continues down here, below the bottom of the screen, and someone asks where did the bear trend begin, you'd say right here. So at this point, it's in a bear trend and in a bull trend. And that's the case with all trading ranges. They're neutral. They have bullish properties, they have bearish properties. It's in breakout mode. Eventually, one side will win. Obviously a trading range, we're going sideways. Lower high here. Clearly the early stages of a bear trend. However, you got a rally and two legs down, one pullback, two. It could be a high two pullback, high two bull flag, and a bull trend. Once the trading range goes on for 20 or more bars, the probability of a bull breakout is equal to the probability of a bear breakout. All reasonable swing setups have about a 40% chance of success. I say that, but there's a 50% chance the final breakout will be up and a 50% chance the final breakout will be down. There's also a 50% chance that the first breakout attempt will fail, and only a 40% chance that any good-looking buy setup or bear setup is the start of a swing. Lower highs, lower lows, bear trend. Higher highs, higher lows, bull trend, but a trading range. And that's the case with all trading ranges. There's always both the early stages of a bull trend and the early stages of a bear trend. And anytime you have a decent signal, like a high two buy here, 40% chance it's the start of a swing up. A decent sell signal, micro double top here, lower high, decent bear bar, 40% chance it's the start of a swing down. In this particular case, the bears won. A big bear bar closing on its high, and a follow-through bar, probably a measuring gap, not an exhaustion gap. And you can see the bulls kept trying to close the gap. They keep trying to make the market go up above this low and that low to close all possible gaps. They're failing. Instead, double top bear flag. This high, that high, expecting lower prices. Trading range, bear breakout, bear follow through, probably at least a measured move down based upon the height of the trading range. Here, the market fell much more than that. Getting higher lows, getting higher highs, early phases of a bull trend. If the market broke to the upside, you say, oh, of course it broke to the upside. We're getting higher lows and higher highs. If it goes to the downside, you'll say, oh, of course it went to the downside. We're getting lower highs and lower lows. Trading range always has both an early bull trend and an early bear trend. 50% chance the bulls will win, 50% chance the bears will win. Highest probability, don't enter until you see a very strong breakout. Lower highs, lower lows, bear trend, higher lows, higher highs, bull trend. This is a close-up of up here, this yellow line, just to show that we had a higher high. This high went a little bit above that high. So this is a higher high compared to that high. It's a bull trap. It trapped traders into buying a breakout. At one point, this was a bull bar on its high, looking like it was going to successfully break to the upside. But by the end of the bar, it was a bear bar closing on its low. It was a failed breakout above the top. Bulls gave up. For whatever reason, doesn't matter. Closed below the low of the past 50 or 60 bars, and a follow-through bar, probably a measuring gap. The bulls tried to close it here, they tried to close it again here, they tried to close it again here, they could not. Several attempts to close the gap fail. You have to expect the reversal down. Traders will be selling for any reason. I began by talking about using limit orders to fade tests of channel lines, top or bottom. I then talked about how most trends begin with a breakout, even if the breakout is not that obvious. I talked about reversals and how breakouts often fail and lead to reversals. Then trading ranges and broad channels. You often cannot tell them apart because they often both coexist. Most broad channels spend a lot of time in trading ranges, and most trading ranges have broad bull and bear channels within them. And that's how I finished up talking about trading ranges containing both bull and bear trends. Every trading range, always 100% of the time, has an early bull trend and an early bear trend within it. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th and final video on channels.